Welcome to Yahoo Finance Live. I'm Shauna Smith alongside Brad Smith. We've got some breaking data out on inflation this morning. The CPI print just crossing the wires on a year-over-year basis, coming in the headline number just a bit hotter than expected at 3.5%. Also on a month-over-month basis, coming in just a bit hotter, 0.4% increase from the previous month. That was in line with what we saw the prior month there. When you take a look at the core CPI print on a month-over-month basis, that was also slightly hotter than what the street was looking for, growth of 0.4%. The core CPI print on a year-over-year basis, that was also slightly hotter there at 3.8%, so holding steady from the number that we saw, the increase that we saw last month here. So a bit of a hotter than expected print here, Brad. And of course, the fear going into this report was that we could see a hotter than expected print, and then the pressure that could put on the markets there quickly as a result.
Yeah, just looking at some of the color behind this report here specifically, as we were taking a look at futures that are in the red right now for the Dow and the Nasdaq and the S&P 500. One huge thing that jumps out to me from this report is the areas here, the food index particularly, and we're going to dive into some of these categories with our reporters. Our newsroom is astir right now with all of the different areas that we're covering. But food index up by about 0.1% in March. Food at home index unchanged. Food away from home costing a little bit more. That's up by about 0.3% over the month. The indexes that increased in March, and this should come as no surprise: shelter, motor vehicle insurance, medical care, apparel, and personal care. And then those that decreased here, and this is going to be interesting for folks here to continue to track and keep score at home. Indexes for used cars, trucks, recreation, and new vehicles were among those that decreased over the month. So areas where consumers, especially on that vehicle sales component, pushing back on prices as well right now.
Yeah, that's really interesting to point out here. When you take a look at some of the drops that you were just mentioning there, used cars and trucks, that was down about 1.1%. It looks like here for the month. New vehicles off just about 0.2%. But taking a look at the reaction that we're seeing playing out here in the market, taking a look at futures, they are under a bit of pressure here. When you take a look at the reaction that we are also seeing in the bond market, we are seeing yields rise on the heels of this hotter than expected inflation print here. So again, this is what the street had been bracing itself for. It is the third straight month that we have seen of inflation that has been a bit too hot, at least for the Fed's liking. And of course, brings up the question whether or not we are going to return to the downward trend that we had been seeing in some of the easing pressures across the board. But let's take a closer look at the reaction that we are seeing. Yahoo Finance's Jared Blickery standing by with a closer look at that. Jared.
Thank you, Shauna. This is a strong economy, and we have to dive into the report, but just the headline numbers alone are sending stock futures south, and you can see that behind me in the upper left. All those numbers that I just circled were in the green, up by about 1/3% or so. Russell 2000 now leading the way down 2.6%. So here is right before the report, you can see it was just in the green and now solidly in the red. That is just a huge swing. And I should say that CPI has played an outsized role in a lot of the stock moves over the last year and a half since we had the October lows basically in 2022. Here is the 2-year Treasury note futures. These are heading down. That means interest rates are heading up. We might see the necessity of even higher for longer, and that's something that the street really has been discounting, hasn't been planning for. That would be the no landing scenario. Here's the 10-year Treasury futures. This is 10-year also heading south in the futures, which means that the rates are surging right now. Let's see what's happened in the gold market. We're coming off of 7, 8, 9 days in a row of higher highs and record highs at that. Gold futures are now down. They had been up. So that's a reversal there. Also taking a look at copper futures, still in the green, though they have paired gains significantly. And I do like to check in on Bitcoin. Bitcoin sometimes reacts, and we can see even Bitcoin heading down a bit there, hovering around 68,000. I just want to take a quick look at the sector action, and all 11, well, I would say it's kind of a split picture now. Financials in the green by just about 17 basis points. So are materials and utilities. But to the downside, it's real estate, tech, industrials, consumer discretionary, communication services, all these cyclical, and also the mega cap sectors just taking a real big hit right now. Guys.
Jared, appreciate it. All right, we're inside of 1 hour until the start of today's trading. Consumer price index for the month of March 2024 coming in hotter than expected. That core rising 3.8% versus the 3.7% that was expected. For more on CPI, we're joined by Victoria Fernandez, Crossmark Global Investments Chief Market Strategist, and Greg Dacko, who is the EY Chief Economist. economists. Thank you both so much for taking the time here. Greg, first and foremost, I want to go to you here. As you're sitting here in studio with us, one of the huge things that we were talking about even before this report dropped, I mean, would it be a dud? Would it be a nothing burger? You know, I was playing white noise by disclosure before we started, just to give us a sense of what we might be coming into. How would you describe it at this juncture?
I think there's no doubt this is somewhat disappointing. Having a reading that's slightly above the consensus of 0.3 for both headline and core is somewhat concerning. Looking into the details, though, I would point out that some of the increases were very specific factors that the Fed perhaps doesn't have that much control over. The price of car insurance going up 2.6%, the price of medical services going up quite strongly. Those are categories that do not necessarily reflect stronger demand, which is really what the Fed is after an environment of cooler demand and cooler inflationary pressures. Now, there's no denying that this firmer inflation print does put more pressure on policymakers to sustain likely a higher for longer type of monetary policy stance. So I think we're going to hear more and more concern around the onset of the easing cycle in June.
Victoria, what are your thoughts just about what this print, the third hotter than expected print that we've seen here for CPI? What does that then tell us about the likelihood that maybe we aren't going to see 3 cuts before the end of the year?
Yeah, so Shauna, I think it's important that it is the third month in a row that we've seen this. You know, when you look historically, a lot of people like to look at a 3-month average. So our 3-month average is actually moving higher. We saw that in the PCE as well, especially in the super core PCE on an annualized basis that was moving higher from 3 and 6 month levels. So you know, Powell said at the last meeting it was seasonality for the January numbers. They weren't too concerned about February. Well, now you've got the third month in a row. So I do think there's going to be some concern around that. It's basically telling the Federal Reserve they're not getting that consistent downward movement towards 2% that they want to see. And granted, as Greg said, maybe they don't have control over some of these elements that are there, but it still puts pressure on them to keep rates at an elevated level. Let's look at what the 10-year yield has done just in the last couple of minutes. We've jumped, 10, 11 basis points. So I think you can see futures market is pricing out rate cuts. I don't think we're going to see 3 rate cuts this year. You already had Fed members come out saying 1, maybe 2, maybe none. We'll see how much more hawkish they get after today's report as well. But I do think we need to dive into the numbers a little bit more to get a better read on what they're going to be looking at.
Yeah, Greg, I saw you shaking your head here. To what extent do you disagree?
Well, I think we have to be careful in what's driving inflation. This is very important to monitor. If you look at core goods down 0.2%, that's still a very disinflationary reading. You look at core services and you look at shelter costs, that has been a key area of concern. That is easing. 0.4% month over month is not a concern. Hotel prices, flat. Airfares, falling back. The first 2 months of the year were extremely noisy. We have to be careful not to factor that in too much, just like we should not have factored in too much the very rapid disinflation that we had at the end of last year.
Victoria, I want to get your thoughts on, we spoke to Atlanta Fed President Raphael Bostic yesterday, an exclusive interview he had with our Fed reporter Jennifer Schomburger about his current projection on this was ahead of this print, but what he had to say about his expectation for rate cuts this year. I want to play that clip and then get your reaction.
Ultimately, it will just depend on what the data show, but I do think the risks are balanced. And given that the U.S. economy has been so robust and so strong and so resilient, it can't take off the possibility that the rate cuts may even have to move further out.
So, Victoria, given the fact that that was what he had to say ahead of this print, and given the reaction that we're seeing in the markets right now, you've got all 3 of the major averages on track, at least it looks like, to open the day off over 1%. If we don't see the Fed cut 3 times this year, how much more pressure do you think we could see on equities here, at least in the short term?
Yeah, I mean, look, it's all going to come down to how far we see yields move and what kind of pressure that puts on PEs for the equity market. I mean, we're at 21 and a half times. That's going to have to come down a little bit. So there's going to be some pressure. A lot of it relies on earnings as well. It's not just all sitting on the shoulders of the Fed and what they do with rate cuts. I think earnings is going to be a key component as well. We know that starts on Friday with the banks. But the longer that we keep rates at this higher level, Right now, the economy is able to swallow that, and we're seeing that with GDP estimates still moving higher. But the longer we're there, the longer pressure, more pressure it puts on the consumer, the more pressure it puts on the labor market. When we start to see cracks there, that will feed through into earnings. So it all feeds off of each other. I think Bostic is right that it could lead to no rate cuts this year. Again, that will force yields higher. It will put some pressure on equity markets. How much? We have to wait and see. A lot of that still depends on the demand and the consumer spending that we're seeing. B of A did come out today with their consumer report showing that some spending has come down. So maybe in the second half of this year, we're going to start to see more of the effects of the rate hike so far play through into the equity markets.
How early do you think we could see a cut this year? What is the Fed's tenor shift towards at the next meeting?
Well, I think we have to be very careful with this idea that it's a play-by-play type of decision-making process.
Sure. They're not running color commentary like a sports game.
And that's very important to keep in mind because there is that impression, investors have taken that impression that Fed policymakers are doing it on a play-by-play basis. Every time there's a new data release, whether it's important or not, there's massive market shifts in terms of the pricing of Fed expectations. What the Fed is really intent on doing is getting inflation comfortably and sustainably down to 2%. For the PCE indicator, we are moving in that direction. These types of readings do still point towards disinflationary pressures. It's not as rapid as what we saw last year, but it is still moving in the right direction, and it's going to take time. I still think that there is this possibility that the Fed will still ease 3 times this year. Perhaps it will wait a little bit longer than June because it does not have sufficient confidence to start the easing cycle. But I don't think we should price out all the rate cuts because we are in an economy that is gradually slowing, where the labor market is gradually cooling, and where inflationary pressures continue to ease.
By the way, I'm just taking a look here briefly at the CME Fed Watch tool. 72% now, staying at the current rate for June, is where the probability has jumped to at this point in time. Victoria, what type of trade does that initiate for you in your mind coming off of a report like this?
Yeah, well, I think, look, when we're investing for our clients right now, we want them to be fully invested in the equity market, but they have to be cautious about where they're putting their money to work because we do think you will probably see a pullback. We haven't seen that 2% pullback that you typically see for quite a long period of time. And in an election year, you typically see low double-digit pullback. So we would be cautious in where we're putting money to work. We would be diversified and put some money to work at these yields in the fixed income markets as well. You can do a barbell on the short end and the long end to take advantage of where those yields are because we probably are getting closer to the higher end of the trading range for yields. Maybe they go a little bit higher, but I don't think we'll go significantly higher from where we are. So you can position yourself to take advantage of when the Fed does start to cut rates. You can get some positive change there in your portfolio value. So we stay invested. The trade for us is to be there, to be cautious in what we're investing in, and to take advantage of some of the yields we're seeing in the fixed income markets.
All right, we got to leave it there. Victoria Fernandez and Greg Daca, thanks so much for taking the time to hop on and react to this hotter than expected inflation print. So let's take a look one more time at the numbers here because we are certainly seeing pressure on across the board when it comes to equities. But when it comes to this inflation print that we have up on your screen there, that headline print coming in hotter than expected as well as core, but on a month-over-month basis, headline increasing 0.4% on a year-over-year basis. It was up 3.5%. Now the core readings on a month-over-month basis, that was also up 0.4% on a year-over-year basis, up 3.8%. So across the board, coming in slightly hotter than what the street had been forecasting here. And you're seeing that reflected in the futures action. About 45 minutes until the opening bell, and you're looking at all 3 of the averages on track to open the day significantly in the red. You got the Dow futures off just around 450, the S&P futures off just nearly 1.5%, as well as the Nasdaq futures. So we'll closely be watching some of the selling action that we're seeing on the heels of this print. Much more on the CPI print coming up right after the break.
Futures lower after CPI. Consumer Price Index for the month of March came in hotter than expected. That core rising 3.8% versus 3.7% that was expected here. We're taking a deeper dive into three sectors in particular that have been hit by sticky inflation: food, energy, and shelter. We've got team coverage to break it all down. I told you the newsroom was a stir. Well, here we've got some of the reporters. We're breaking things down on the sector basis. Yahoo Finance's Brooke DePalma, Madison Mills, and Danny Romero standing by. Brooke, let's start with you. You're watching food as consumers continue to grapple with high grocery prices.
Yeah, good morning, Brad. Certainly yet another month where we saw overall food inflation see an uptick month over month, up 0.1%. Now that is compared to flat in the previous month, and year over year continues to see a deceleration, but not a decrease here. Year over year up 2.2%. And then when you take a closer look at food away from home, that's what's really driving this higher food inflation. Think of dining out at restaurants, at bars. That was up 0.3% month over month, and the cost of groceries were unchanged. But some of the items that we are tracking in particular includes the cost of eggs. We did see a jump month over month of 4.6%, and that's largely because of the impact of certain bird flu cases popping up at some of the largest egg producers here in the U.S., including Cal-Maine eggs. Sugar and sweets, also something we've been tracking, is the price of cocoa has seen a major uptick recently. That did tick down last month. Beef and veal up slightly. We are seeing a lower cattle supply. Many experts telling me that that is sticking around. Other items that did see a jump in price include frankfurters, chicken, lettuce, and roasted coffee last month, and we'll continue to keep a closer eye on how those play out later on this month. Maddie, I know you're watching energy, where we saw prices ease earlier in the winter. What did we see from this report?
Yeah, we're still seeing those energy prices rising here, but they are rising at a slower pace here. So if we take a look at these numbers, month over month, we saw a 1.1% increase in energy. That is down from the 2.3% increase we saw in the prior month. That brings the overall energy index up to 2.1% growth year over year here. Now, I want to point out that this was a beat when it comes to what we were expecting from the energy sector, but we are sort of seeing a broad, minimal beat across a lot of the different sectors when it comes to the overall consumer price index print here. So when you look at that overall broadening, it does indicate bad news for the Fed, because they're seeing a lot of areas with price increases, not just one specific area. Having said that, the Fed does strip out shelter and energy. When it comes to that super core number, that is hitting 4.8%. That is not what the Federal Reserve wants to see. Shelter and gas contributing over half to the overall monthly increase when it comes to this CPI print. Again, this is not a massive beat in energy, but the general hot headline does indicate a broadening of that inflation. Danny, I know that you are watching shelter, which is contributing a little over a third to the CPI print. What do you have?
Maddie, shelter costs remain sticky, but the results show that it's slowly easing. On a yearly basis, shelter came in at 5.7%. That's lower than last year in March, where shelter inflation peaked at 8.2%. And now on a monthly basis, shelter posted a 0.4% gain. Shelter costs accounted for 60% of March's overall monthly gain in all things minus food and energy. But there are two components that hold the biggest weight in this shelter figure. That's owner's equivalent rent, OER. That's the hypothetical rent that you would earn if you rented out your property. OER landed at 0.4% monthly gain. And the second component is rent, which lags real-time rent data, and that reached 0.4% monthly increase. Now, current rent data does show that rent prices are increasing month over month, but still down annually. So is this increase in rent prices somewhat concerning? Some economists say no, because the Fed wants to see real-time rent data move toward that 2% inflation goal. Bottom line, the housing market is still recovering, and the tight supply is still pushing people to stay in that rental market. Some Wall Street economists expect shelter to bottom out by spring or July of next year. Shauna, back to you.
All right, Danny, thanks so much. We want to take a look at the reaction that we're seeing play out in the markets right now, because the futures market really on the move on the heels of this hotter than expected print, the third hotter than expected print that we've gotten for CPI here in a row. So you can see the huge move to the downside for the Dow futures right after that report was released. Now on track to open the day off just about 400 points. When you take a look at the S&P futures, that also moving to the downside, the dip at the same time, now on track to open off just about 1%, over 1%. The same is the case for the Nasdaq futures. We also want to take a look at the activity of what we are seeing play out in the bond market, because you can see when you take a look at the 10-year prices at least moving to the downside, which means yields, rates actually surging on the heels of this print. The same goes for the 2-year as well. You can see that downward move for the 2-year in terms of prices. That means rates obviously surging there. When you take a look at gold, we've been talking so much about gold right now, the pricing action that we have seen over the last several weeks in the lead up to this print here. We had seen a bit of a move to the upside, or a huge move, I should say, to the upside at record highs heading into this print. You are now seeing a bit of a move to the downside. We had briefly dropped right after the report was released, but right not too far from the flat line at this point. And taking a look at a longer term chart when it comes to gold, you can obviously see the fact that we're not moving in a bit of a reversal, a bit of a downward move here for gold futures, at least now kind of stemming or at least halting some of that upward momentum that we have steadily seen in this chart here over the last 2 months. And then real quick, I want to take a look at the price of Bitcoin, because it's always interesting to check in on the price of Bitcoin, especially on the heels of a move like this that we are seeing in the futures market. You could see that dip right there on your screen right after the release, right after the CPI print was released. And you can now see the pressure of it off just about 4% right now, just below 68,000.
All right, thanks so much, Shauna. We've got much more on this as March inflation coming in hotter than expected. Shelter contributing to just over a third of the CPI print. Let's do a deeper dive into Shelter with Tiffany Wilding, who is the PIMCO Managing Director and Economist. Tiffany, great to see you as always. Just want to get your takeaways here from the Shelter component here. As report after report, we continue to see Shelter be the index that is really driving much of the stickiness in the inflationary picture right now.
Yeah, well, certainly shelter has come down, I think, much more slowly. Shelter inflation, that is, not the actual price level, but shelter inflation has moderated much more slowly than I think many people expect. And I think the reason for that is that, you know, the BLS, when it's measuring rents, it is not only looking at what we call market rents, so rents of leases and homes that are literally changing hands, they're turning over, and those new leases, but they're looking at the average rent across the entire rental stock. So those folks that are staying in their rental units, or they're renegotiating prices after being in their rental units for some period of time, they're also capturing those. And you don't have a lot of real-time good data. But ultimately, what we know is that the rents of the things that aren't turning over, those rents are actually under market levels now. In other words, you have landlords that are still trying to catch up by raising rents at incremental levels, you know, for the folks that stayed in their properties. And that's what we think is causing the stickiness in shelter. So although, you know, your market rents measures, even, you know, in the Sun Belt, even maybe they're even coming down a little bit on a price level, you know, they look like they've moderated. That's just not flowing through to the BLS data, because the large stock of rental units in the country, you know, still are below those levels, and they're catching up. So I think that's one of the things that people are certainly missing.
Tiffany, what does that then tell us about future progress, or lack thereof, I guess, on inflation? Is it likely that we're going to get stuck at these elevated levels?
Yeah, I mean, I think for the shelter components, what it suggests to us is that yes, you will still see moderation on a year-over-year basis. You know, but we're not convinced that you're going to get back to, so the shelter components were running around 3 to 3.5% inflation pre-pandemic, and we think it's going to take a while to get there. And the fact that you have just a broader shortage of housing, you know, within the housing market as a result of years of underbuilding since the Great Financial Crisis, suggests to us as well that you will probably settle in at rental inflation levels that were above those of the pre-pandemic period. So we're not convinced that rents and moderating rents are really going to get you sustainably back to 2%. And that, but of course, that absent, you know, weakening in the labor market. Of course, you know, all of the game kind of changes here. If you start to see the unemployment rate move up, you know, and you start to see job losses, of course, you'll get more rental inflation, disinflation at that period. But absent that, rents look like they're going to continue. Rental inflation is going to be sticky.
And it comes back to capacity, both on the home side and on the rental side. And on the rental side, there's a lot of construction build outs that a lot of people who have rents are waiting to get completed so that they have opportunities to move elsewhere, get more favorable pricing. What does that capacity part of the equation look like from your purview?
Well, one of the interesting things that's going on in the rental market is there's a bifurcation in market rental trends depending on what kind of a structure it is. So not to get too wonky, but people since the pandemic have had a preference for a single family, I guess, more suburban type of structure out of larger cities. So what we're seeing in the rental markets now is that where you're seeing the pricing weakness is in the multifamily structures that had a lot of building post-pandemic, specifically in the Sun Belt, in some of these, kind of more medium-sized cities. There's a lot of overbuilding there. And a lot of that supply is now coming to the market, and it is resulting in discounted, 1-2 month kind of free discounting of rents when you sign your lease. But however, nevertheless, that weakness in the multifamily structure category, that's not really spilling over, in large degree to the single family detached categories. So everything else is holding up pretty well. And again, the BLS, when they're measuring this, they're capturing the broader rental market. They're not just getting those single or multifamily structures. So you have to take this into account, and again, all of this suggests to us that the broader shape of the housing market, very firm, very strong, and you're going to see that come across in just rents remaining sticky as well.
All right, Tiffany Wilding, always appreciate you giving us some insight, especially on a day like today when we're seeing some of the reaction here in the markets, obviously, to this hotter than expected CPI print. Tiffany, thanks. Coming up, we will do a deeper dive into that March CPI print. Again, taking a look at futures reaction. You are seeing pressure across the board. Dow futures off just around 400 points. And as we're seeing futures drop, you're seeing yields soar. You got the 2-year and the 10-year yields both soaring to the upside. More on that when we come back.
It's 9 a.m. here in New York City. I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance's flagship show, The Morning Brief.
We certainly have a lot of ground to cover this Wednesday morning. Futures, well, they are falling sharply, and Treasury yields, they are jumping on the heels of a another hotter than expected inflation print. We will talk about the path forward for the Fed throughout the hour.
And shares of Delta Airlines taking off this morning after the airline beat Wall Street's expectations for the quarter. I spoke with the CEO, Ed Bastian, on the travel industry's resilience, Boeing's aircraft issues, and much more. We'll bring you that interview shortly. So let's get to it with the three things that you need to know, your roadmap for the trading day. Yahoo Finance's Jennifer Schonberger, Jared Blickery, and Madison Mills have more.
Futures down this morning after the consumer price index clocked in hotter than expected, fanning fears that the Federal Reserve could scale back the number and timing of interest rate cuts this year. The so-called core CPI, which excludes those volatile food and energy prices, clocked in at 3.8% for the month of March, holding the same level as February. Atlanta Fed President Raphael Bostic told me in an interview on Tuesday that if inflation were to stall or the economy were to accelerate, that could mean pushing out the possibility of rate cuts this year.
And at this point, I think it's 1, but as months pass, I may move to 2, or I might move to 0, and we'll just have to see where the chips fall.
Investors now pricing in a nearly 70% chance that the Federal Reserve will not cut rates in June.
Plus, Delta Airlines' first quarter results flew over Wall Street expectations. The airline's strong results were driven by a resurgence in corporate travel as more consumers look to book flights. Delta Airlines CEO Ed Bastian also sees an uptick in travel demand in the spring and summer.
This year to date, we've seen the 11 highest sales days in our company's history. That's a strong predictor that spring summer season is going to be quite healthy on the travel side.
Delta is the first airline to report first quarter earnings for 2024.
Shares of Nvidia are falling as the AI darling enters correction territory there. That means the stock is down 10% from its all-time high, but shares of Nvidia still surging. Of course, if we look at the year-to-date returns, it's at 72% for the year, but looking like it's down a little over 2% in the pre-market this morning.
Well, today's top story, U.S. stock futures selling off on this hotter than expected March inflation print. The headline number rising 3.5% over the prior year. The acceleration from February's 3.2% annual gain in prices. Joining us now on this, we've got our very own Alexandra Canal. Hey, Ali.
Hi, guys. Yeah, so it looks like, just like the Fed officials have been telling us, a path down to 2%. It's going to continue to be bumpy. Inflation coming in hotter than expected across the board. We were just talking about our interview with Raphael Bostic. He said if inflation came in at consensus, that would be welcome news. That did not happen here. We saw higher than expected inflation in really key areas like shelter, gas, food at home. These are all areas that consumers, feel day in and day out. When it comes to the future path of interest rates, it looks like that could very well be pushed out. According to Fed futures, just 20% are now anticipating a cut in June. That's down from about 60% that we saw yesterday. It looks like, according to this data, that we might not get the first cut until September. We know that Raphael Bostic, he said he expects one cut in the fourth quarter. We'll see if that continues to change here, guys. But all in all, it looks like this is a complicated space for the Fed to be in as they navigate interest rate cuts, as they navigate when and how many cuts they should commit to. But clearly this data, along with that hotter than expected jobs report that we got recently too, it's not great news for the Fed when it comes to the clarity of what they should be doing.
Certainly not, and it's a very tough job that Powell and his team have in front of him. That is for sure. Ali, thanks so much. Well, futures, they are sinking on the heels of that hotter than expected CPI print. The move lower coming as investors adjust and recalculate their expectations for Fed rate cuts. Now, the move lower today, it's coming on the heels what the market has really posted as a strong start to the year, continuing some of the gains that we saw last year. You got the S&P at least year to date up just about 9% ahead of today's open. Despite the uncertainty surrounding the Fed and rate cut outlook, our next guest saying that he thinks that the S&P 500 has more room to run. He has the highest year-end S&P target on the street. We want to bring in Chris Harvey, joining us here on set, Wells Fargo head of equity strategy. It's great to have you on set, especially on a day like today. So before we dive into your year-end target, just your quick reaction to this print and what this means for equities, at least in the near term.
So obviously it's a pretty ugly reaction, but here's a takeaway. If you look at futures, what's down the most? Small caps are down the most, right? And for us, this is kind of a perverse statement. We actually want the Fed to go slower, because if the Fed goes slower, that keeps the status quo in place. The market is a momentum growth large cap market. It wants the status quo, and we can work higher from here. We never thought the Fed was going to go in the first half. But the big and the important thing is that the Fed's going to start a multi-year easing cycle. We can argue about when and how much and so on and so forth, but it's the fact that it's a multi-year easing cycle. If you go back to 21 and 22, 21 was a great year. We had a lot of accommodation, actually too much accommodation, but it ran into a buzzsaw in 22 because the Fed got very aggressive. You're not going to see that in the future, and I think that's the key takeaway.
What's the multi-year easing cycle playbook then? I mean, as of right now, sure, there's the pause, I guess, we can consider, but then there's got to be a pivot, and portfolios have to adjust as well in tandem.
Yeah, for now, what we're saying is it's a growth market. We think it's going to continue to be a growth market. This whole belief that that growth is suddenly going to explode, not true. The economy is better than expected, but it's not very strong. So I think what you want to do going forward is you want to have a balanced approach. You want to have some growth in it. On a sector basis, we're telling people to be overweight the communication space, but you want to barbell that, or you balance that with something defensive, either healthcare or utilities for days like today.
So the print like this, that doesn't change your base case at all, or the fact that you still believe, at least in the second half of the year, that we will see a further move to the upside?
No, it doesn't. And we've been expecting volatility. We've been surprised that it's been so placid. And we thought you'd get some volatility in the first half of the year. We haven't gotten it yet. Maybe this is it. Maybe rates go a little bit higher. It upsets the market. But that's fine for us because we think the status quo is here. AI, that secular trade, is here. The Fed is going to be cutting for a long period of time. And we may see an acceleration in M&A activity related to some of the regulation change with the election.
All this considered, we're staring down a fresh earnings season at this juncture too. What do you think the theme is that prevails this earnings season off of prints like this, and with what you were saying about the resilience but not super strong nature, or at least profile right now of the economy?
Yeah, I don't think you want to go out too far, and I don't think CEOs are going to be too aggressive, but they'll say, hey, we have opportunities, hey, pricing is still okay, the economy's still okay. They'll give you some risk, they'll give you some rewards, but it won't be anything. You don't get paid to get too aggressive at this juncture. So I think the results will be fine. I think they will be good. If we do have a sell-off, I think that will help firm the sell-off or help improve things. But don't expect fireworks at this point in time.
Chris, one of the risks that you brought up in your most recent note was elevated yields, and not exactly at the levels that you were talking about within the note, but we are seeing this huge move to the upside in yields today. You got the 10-year yield above 4.5. What kind of pressure then does that ultimately put on markets? I mean, you're talking about that level that you are looking at as a potential risk. What is that level and why?
So I think you have to bring rates to 5%. You have to keep them there for a long period of time. Right? And what we've seen in this market is it's a momentum market, not just in equities, but also in rates. Right? And so when rates start to back up, they can gap higher. And that's a concern, but they have to stay there. And we just don't see enough for it to stay there. Right? Inflation ultimately is coming down. The more time you add, the more it will come down. 2% I think is aspirational, but it's hard to see that, people are talking about 8% on the 10-year. I think that's just kind of silly talk. 5% I think is the high. I don't think if we do get there, I don't think you stay there, and I think we come back down because inflation's coming down. It's still a low growth environment, but what it does is causes some volatility.
You mentioned healthcare a moment ago. Is healthcare your top sector right now? What is that top sector pick for you?
The top sector is communication. What we're using, healthcare or utilities, it's a barbell, right? We're going to get some volatility. We're going to get some stress in the marketplace. You want something to balance out that portfolio, and healthcare's there. It's good valuation. It's been beaten down, and in times of stress, it generally works pretty well.
Chris, going back to what you said just a moment ago, when you're talking about some of the factors that could drive that upward momentum in the second half of the year, you mentioned increased M&A activity on the heels of the election. What more specifically are you looking for there? And then in terms of the activity, if we do see a change, what that could look like?
So what we're looking for is we're looking for a change in the Senate. If the GOP takes the Senate, and it looks like it's better than a coin toss that they will, a lot of regulation, it's not so much that regulation comes out of there, but the GOP is more market focused. It's less regulatory, and so you would expect a lot more activity on M&A if you get a GOP that controls the Senate, unlike what we're seeing today.
Chris Harvey, Wells Fargo Head of Equity Strategy, joining us here in studio. Chris, thanks so much for taking the time.
Thank you.
Absolutely. Well, shifting gears to our first big earnings report of the season. Shares of Delta Airlines moving higher after posting better than expected first quarter results on the top and bottom line. I had a chance to catch up with Ed Bastian to discuss the earnings report, and he was confident about summer travel demand. Take a listen.
We have seen some real strong demand, Brad. It continues. That momentum has continued internationally. It's continued domestically. One point of evidence is that this year to date, we've seen the 11 highest sales days in our company's history. That's a strong predictor that spring summer season is going to be quite healthy on the travel side.
And joining us for reaction here at the Yahoo Finance studio, we've got Steve Trent, Citi Airlines analyst and managing director. Steve, always a pleasure to have some of your insights as well on the back of an earnings report like this. I mean, what was some of the major things that stood out, the catalyst that stood out to you from this report?
Yes, appreciate that, and thank you again for having me on. I would say the revenue diversity was very impressive. So we have loyalty, co-branded card revenue, premium cabin, maintenance, repair, and overhaul. The revenue diversity, I think, was very impressive. This is something that goes well beyond main cabin. And I think that's one of the distinguishing factors that we're seeing, for example, with the network airlines versus the discount carriers, and we're less sanguine on the latter group.
See, what is it that Delta is specifically doing to better position themselves at this point, given the fact that, yes, their results, we did see, it's almost like a rising tide lifts all boats, at least right here initially in the reaction. But what is it that's giving Delta an edge at this point?
Yeah, absolutely. So I would say the premium cabin is a place that's done very well for them. And they've also distinguished themselves significantly on co-branded card revenue from American Express. So especially in the latter segment, they're really outpacing everybody else. But beyond that, I would say years and years, this is a carrier that's been very serious about branding and maintaining a very good brand. And that encompasses everything from being the only U.S. carrier that did not dilute its equity holders during the pandemic, the very last airline to unblock that middle seat in those dark days of COVID-19. And I think these strategies are paying dividends, on top of them paying a cash dividend, of course. So you look at the confluence of these factors, it's a very positive picture.
You know, it's remarkable, kind of quarter after quarter, getting a sense of how Ed Bastian and the team, Dan Janke, how they're thinking about risk assessment as well, and how they steer this business particularly. And it came up in our conversation as well with regard to how they are even navigating what's taking place with Boeing as well. I mean, this is an airline that easily could have said, hey, yeah, we'll dive headfirst into the MAX and make a big purchase order. They didn't. They waited until the MAX 10. Is the significance of how they're operating right now as well, and the results that they're seeing right now, the fact that they are not a company that has the MAX in their fleet and they can push that off to later on and not have those same type of headwinds right now?
Yeah, absolutely. They've been very good, I would say, about fleet planning and other kinds of planning. You know, the entire industry at this moment is facing these problems with respect to capacity constraints. We don't have enough equipment. We seem to have the crew issue under control at this point. But you know what Delta's done there, as everybody's fleet is going to age somewhat, they have been very good about maintenance. They have a nice Delta Tech Ops MRO facility. I'm sure that's helping out nicely versus some of their competitors. So I would say this team has not taken a knee-jerk reaction to refleeting or branding, or pricing. And I would say the dearth of capacity per capita today is going to possibly put upward pressure on fares, which maybe that's not 100% good news for the consumer, but for the earnings stream, it's promising, very promising.
You know, it's interesting. Ed also expressed confidence in the new Boeing chair. He said he has a personal relationship with Mollenkopf. What would you like to see in the selection of the new CEO at Boeing, as the rest of the airline industry really is going to evaluate who that figure is?
Yeah, absolutely. So it would be a touch out of my wheelhouse to comment on that specific company, but I would say from the airline side, what people definitely want to see is some restoration of confidence. You've had several incidents, of course, with mechanical mishaps on flights and emergency landings and this kind of thing. From a statistical perspective, these are not necessarily sort of a higher amount of mechanical issues than you usually have, but the optics are bad. So I think we need to, in that case, from the supplier perspective, give the group some confidence that they've righted the ship and they've righted the ship. At the same time, that's something that should also help the consumer to become more comfortable with flying. And I wouldn't say that's fallen apart by any stretch of the imagination, but you have seen a little bit of book away, for example, on the back of some of these incidents that occurred earlier this year.
At least it looks like in the pre-market, Airlines could be a group that is still the winner today on the heels of these the print that we got from Delta, up just about 2%. Steve, thanks so much.
A pleasure.
Let's get to a stock that we're closely watching here, and that is Nvidia, now entering a correction territory after falling more than 10% from its recent highs. Yahoo Finance's Madison Mills has a closer look at the pricing action that we've seen. Maddie.
So why is Nvidia down today? Well, I just got off the phone with Steve Sosnick, friend of the show from Interactive Brokers, and he told me trees don't grow to the sky. A pullback in a name that is up over 70% year to date is gonna be a normal thing to expect. What's weird was the rally, not this pullback that we're seeing. But why this degree of pullback? Well, there could be a couple of reasons here. One of them being that we are seeing some competitors coming into the space. A competitor would see Nvidia's performance and think, I would love to get in on that. That's exactly what we're seeing from the likes of Intel announcing their new chip. Having said that, Intel has not made clear which companies are going to be purchasing and becoming customers of that chip. So I think investors are waiting on hearing some of those big ticket names like the Apples of the world coming in and soaking up and getting up those chips from Intel before diving into that name. Also coming up on Monday in terms of the Nvidia trade, what do we have? We have our taxes due. So investors might be looking at Nvidia and the returns that they've gotten year to date from them and having a little bit of profit taking as they have those bills due on Monday here.
And staying in the chip space, Taiwan Semiconductor getting a boost in the first quarter sales here. What do we know on this, Maddie?
Yeah, so TSMC, the largest chips manufacturer in the world. This is a foreign firm, but they are getting some funding from the CHIPS Act. They're planning to spend $65 billion on the third plant in the U.S. That's going to be their plant in Arizona, third plant overall, rather. The key kind of criticism of TSMC is that a lot of their manufacturing is focused in Taiwan, and we saw that that was an issue following the earthquake last week, but they are starting to try and work on that and diversifying. They've got a fab opening up in Japan, so that leads to a little bit of diversification there. But again, we know that the chips market is supply constrained. That's why Nvidia has had such great returns, so it makes sense to see some of the other players in the competition beefing up in this space.
Maddie, thanks so much. Tracking all things chips, and that comment about the trees not growing to the sky, it's getting quite some play in the internal Slack channel here. All right, thanks so much, Maddie. Coming up, futures are in the red after that hotter than expected CPI report. We'll dive into what all of this means for the Fed throughout the hour. Plus, Boeing's crisis deepens with the 787 now under scrutiny. We'll discuss the latest after the break. Plus, Jack Ma comes out of the shadows. We'll discuss the morale-boosting post from him that's sending shares of Alibaba higher. Let's take a look at some trending tickers. More trouble for Boeing after an engineer for the airplane maker filed a complaint with the FAA, claiming shortcuts were taken when assembling its 787 Dreamliner jets. I spoke with Delta Airlines CEO Ed Bastian regarding any concerns around Boeing, and here's what he had to say.
I have confidence in the company. Strong company. It's an important company. And I still have confidence in the company. I think we all know it's going to take some time before they get the overall level of quality and production where it needs to be. And the board there decided to make a change in the leadership. And I have a lot of confidence in Steve Mollenkopf, who's the new chair. I know Steve personally. I think he's a great choice for the chair, and I'm confident he's going to make a good long-term leader for that organization, not just the CEO, but the team as a whole.
And you really do hear many of the airline executives, it included, reiterating how important this company in Boeing is to the large plane manufacturing in the world here, as 90% of the large plane orders, according to data from Teal Group, of course, comes in for Boeing and Airbus here. Those two account for 90% of those large plane manufacturing. So Boeing getting this right, and the companies continuing and the airlines continuing to show confidence in them at the same time where they're looking for answers as well here. They're trying to make sure that a lot of the issues that have really impacted even their own orders get rectified in the very near term before it further impacts route schedules as well.
Yeah, right now they still have the confidence of the airline leaders, but I think there are lots of questions. And even just take a look at the street's reaction, take a look at investors' reaction. They're not convinced that Boeing's troubles are over. When you take a look at, it's falling another 0.9% today, but when you take a look at a longer term chart, that year-to-date chart really shows the pressure that shares have been under ever since the start, most recently for Boeing's troubles. And you're looking at year-to-date losses of just over 30%, one of the worst performers that we've seen this year among some of the components that we watch here. So it does beg the question of what it's going to take in order to convince investors to get back on board, one of the worst performers within the Dow this year. So we're still seeing, when you get a report like this, or this whistleblower report, it also brings up obviously more questions about what the future could look like here for Boeing. And then not even to bring up the leadership changes that we're going to see, a number of increased regulatory action that we will likely see, oversight that could pressure the stock, at least in the near term.
I was just looking at the extended hours trading as of right now. We could be looking at a new 52-week low today for Boeing if we dip below 176.25 here. So we're taking a look at that already here in pre-market trading.
Let's take another look at a stock here that is a trending ticker, and that is Alibaba. Shares moving to the upside following a rare memo from co-founder Jack Ma. You're looking at gains of just about 2%, so bucking that downward trend that we're seeing in the broader market. But Ma writing that the company was, quote, returning again from an organization that makes decisions slowly back to the highest levels of efficiency. And why this is significant is this is Jack Ma returning from seclusion for just the second time in several months here. He's trying to help morale. He's now supporting the efforts of the leaders here with Eddie Wu and Joe Tsai. And this is a bit of a different tone than what we heard last time he emerged, really criticizing the direction of Alibaba and some of the decisions that have been taking place. So now he's saying that he thinks Alibaba's on the right track, and we're seeing gains of just about 2%.
What is the track? Tracking all the moves in Alibaba and which businesses they're spinning off and which ones they're splitting up. I mean, it's like trying to track Pepe Sylvia at this point. I mean, it's crazy. So all that considered, if Jack Ma, and he is really able to reinstill for a lot of the employees that are still at Alibaba, that they can have confidence in the direction, we'll see if that ultimately pays off here. But shareholders have to be wondering what in the sum of remains here for Alibaba, as they were talking last year about splitting up into 6 different entities, and now we're trying to figure out which ones are still going to be combined with one another, what the investors are actually getting a share of, what are they actually getting equity in, and what are the margin profiles of that as well.
Yeah, we're talking about e-commerce, cloud, and AI. All right, well, coming up, we are just minutes away from the opening bell on Wall Street. Again, we are looking at pressure across the board on the heels of the hotter than expected inflation print. You got Dow futures still off just about 400. We'll be right back.
Oh yeah, we've got a good look at the opening bell where you've got what looks like the cybersecurity National Security Index ringing the opening bell at the Nasdaq. And then at the New York Stock Exchange, you've got, pronunciation either Ona or Auna, or
I think it's Ana.
As the French might say, oh nah, or as they might say in your hood, oh nah. So could be any of those. We'll see which one it is. We'll get some clarification on that. Nice little flag that they got going on over there. All right. Everything's officially opened up. We've hit the opening cross, and we've got a live look at the Wi-Fi Interactive and some charts here on the board for you. Dow Jones Industrial Average slips lower. This is all, of course, coming after that March CPI print, coming in a little bit hotter than expected, impacting the major averages this morning, Shauna.
It certainly is. When you take a look at the S&P, that's also moving to the downside, falling just about 1%. You can see that drop right here to the right of the screen, coming off of what has been a couple of days here, or at least we saw some variation in the pricing action over the last couple of days. When you take a look at the Nasdaq Composite, that is also opening the day to the downside, off just about 1.2%. Let's take a look at what we are seeing in the bond market. Yields shooting to the upside. You've got the 10-year yield right around 4.5, so up 14 here basis points. So again, critical action to look for here. When you take a look at some of the reaction that we're seeing within the bond market, flipping back over though to equities and the sector action. Red. I'm matching the screen right now. Red across the screen. I didn't even mean to. Real estate, you got that off nearly 3%. Utilities selling off. Consumer discretionary, the list goes on. Energy, though, right around the flat line. But again, this really just paints to the broader market pressure that we are seeing across the board on the heels of the fact that inflation proving to be much stickier than traders and investors and even the Fed had anticipated it to be up until this point.
How do I get on the red memo listserv? I just need to be able to be on that email
I should have worn a green
list.
jacket and maybe we could have gotten a better print.
Oh, I saw a couple of those yesterday for sure. All right, everyone, we got a deeper dive into the market action. Yahoo Finance reporter Jared Blickery standing by. Hey, Jared.
Thank you, Brad. I'm going to add you to that list server right after this. But as you were just pointing out, that is a sea of red in the sector action. Very notable that utilities and real estate, the biggest losers. We have the 10-year T-note yield screaming higher right now, and that is because of that hotter than expected CPI print. And the markets have reacted very either favorably or unfavorably to CPI in particular over the last year and a half in this bull market. Let's take a look at some of the leaders here. We can see also another sea of red, although gambling, it looks like bets in the green there. Chinese stocks, we were talking about Alibaba, that's just barely in the green. But for the most part, we're seeing a lot of downside action. Home builders, cannabis, regional banks, solar, and also Korean stocks just taking a leg down. So you got value, got cyclicals kind of going down in lockstep. And here's the Nasdaq 100. Not seeing a lot of dark red. So this is not a disaster, but certainly not bullish. You can see Pinduoduo, another Chinese stock, that lone green square right down there. Just checking in, I want to take a look at Alphabet, a little bit longer term look. This is a stock that just broke to record highs. Given the length of consolidation here, you got to think it's probably due for some higher prices, although today taking a little bit of a backseat there. Let's take a look inside tech here. We're going to take a look at semiconductors first. Taiwan Semi, Asian stock, that's in the green, but for the most part, we're seeing red here. Nvidia at a 1-month low, that's down about 1.4%. Taking a look at software too. Software also looking weak. And then finally, unprofitable tech, and that is another disaster in the making here. I don't want to send everybody off on too bearish a note here. We have to see what happens in the close here, but very bearish action to begin the day.
Certainly, we are looking at losses here across the board when it comes to equities. All right, Jared, thanks so much. Let's take a look at the price of gold, because you have gold futures that have been seeing a lot of movement here in early action, now trading to the downside. And this comes after the precious metal has actually hit 9 consecutive trading days of intraday record highs. Now, after today's CPI print showed that prices remain elevated, higher than what the street had been forecasting, traders are now starting to hedge their bets while the path to rate cuts remains murky. So here to break all of this down and more, we want to bring in Francisco Blanche. He is Bank of America's Securities Head of Commodities and Derivatives Research. Francisco, it's great to have you here. So when you take a look at the pricing action that we've seen in gold, census print came in just a bit high. You have gold retreating just a bit. What does this give us a sense in, just in terms of how the gold bulls are looking at this print and what this could tell us about future moves?
Hey, Shanna. So thanks for having me. Look, we've seen tremendous gold buying on the back of central banks, and more recently, there's been retail gold buying in China. But I think we have to distinguish the kind of temporary cyclical rate factors driving gold here from what's more structural. And in the case of gold, I think there's a real big structural trend towards more gold purchases driven by the major geopolitical fracture that we have in the world today between US and Europe on the one side and Russia, China on the other. It's really been central banks, not trusting central banks, that has been behind the buy the dip mentality in the gold market. Now, having said that, people have gotten maybe a little bit too excited, and the expectation of interest rate cuts was maybe adding more longs to the gold trade, which of course are retracing today with the inflation print. That's the story. Inflation print's hotter than expected, makes the Fed less likely to cut in June. Why own gold at this stage? There's better alternatives yielding higher returns, and that's I think the battle, if you like, that we are seeing every day.
What is the pathway for gold then if we don't see the Fed cutting rates until late this year, maybe even Q4, or at some point early next year, the bulk of those cuts coming?
Well, for starters, Bank of America, we have 3 rate cuts penciled in. So we're still calling for a rate cut in June and 2 more in the second half of the year. So based on that, we think gold prices continue to go higher. But there's definitely a challenge for the gold market if the Fed doesn't cut rates this year, or as some people have claimed, if the Fed hikes rates, I think it'll be pretty bad for the gold market and particularly for gold positioning. We've also seen a reflection of some of that in the currency markets, with euro-dollar suddenly softening up towards 109 and quickly reversing that all the way to 107.50, 107.60 as soon as the inflation print has come out. It's not just gold, it's also the fact that higher inflation in the US leads to persistently higher interest rates, persistently higher, stronger dollar, and therefore makes assets like gold less valuable. So there's a risk on that gold trade, and the risk, of course, as you pointed out, is the Fed doesn't cut or potentially hikes.
And then what would that mean then for prices, just in terms of the pressure that we could see? How much pressure could we potentially see?
Well, I mean, I think if the Fed starts to hikes again, I mean, you could see potentially quite a little downside pressure. Although I would expect central banks to come in and eventually put a floor on the market. Central banks are not going to be chasing the gold market higher. They're going to be buying on dips. And remember, here we are looking at the cyclical elements, which are connected to the rates and FX cycle, versus the structural elements, which are a lot more driven, in our view, by the fact that Russian central bank assets were frozen after the Ukraine war started, and the fact that we've had some major monetary and fiscal policy mistakes for the last 3-4 years, which led to this inflation wave, and they have left us, frankly, with very, very wide budgetary deficits that the buyers of those European government bonds and U.S. treasuries are a little worried about, to put it mildly. That's the other big issue here at heart.
And then going forward from here, what other commodities then do you like outside of gold?
So we think oil coming into the summer is going to do well. We think oil into the summer months will kind of top out around $95+ a barrel. We think gasoline and diesel are going to go along that. So we'll see a firm run up in fuel prices. OPEC has a strong grip on the market. It's going to be another a bumper travel season, just like we had the last 2 or 3 seasons post-COVID. People want to travel, want to spend money. And also the other commodity we really like at this stage is copper. We think the copper supply crisis is here. And we also think that copper is going to rip to around $12,000 per ton into next year. Now, the copper story is not only cyclical with kind of lower rates potentially supporting the market higher and a restocking cycle, right, which is really the short-term story. There's also a structural element to copper, which is the energy transition, is the need to upgrade the U.S. grid, the European grid, the global grids need to be upgraded to make them friendlier to renewables and to the electrification of everything, and to the big wave of electric vehicle sales that started a few years back and will continue over the course of the next 5 years.
Yeah, the massive run-up that we've seen in copper prices already has certainly been astounding to watch. Francisco, before we let you go, going back to what you just said a minute ago about crude and the gains that we could see here going into the summer season, the biggest factor driving the price of crude, is it demand at this point, or is it supply, given the fact that we are seeing the increase in geopolitical tensions?
Well, I mean, we haven't, to be clear, we haven't lost any meaningful amount of supply. Geopolitical tensions, interestingly enough, for the first time in a long time, have manifested themselves into more demand. Why? Because ships around the world are having to travel longer routes. They cannot go through the Red Sea. And also, they have to travel faster because by virtue of having to go into much longer journeys, you have to speed up those ships. And that's a good chunk of the upgrades to global demand growth in the last 6 months or so have really come from that. I would say as much as half of the re-rating in incremental oil consumption growth rates has come from that. There is a cyclical element, and why is the Fed not maybe potentially not cutting rates in June? Well, it will be because the economy is doing better and because inflation is stickier and things are ultimately stronger. So there is that element of demand. But I don't think there's a massive kind of supply story building here in terms of supply losses. Now, OPEC has definitely convinced over the last 3 months other members. We've seen Saudi pushing the envelope here and getting other members to contribute reductions in supply in line with the agreements that were made in the month of December when Angola, remember, left the organization with a big splash. So clearly the group is coming back together. There's more cohesion. So there's an element there as well on the supply side that is driven by OPEC. So that also, in my mind, kind of limits the upside because the group will likely want to regain some market share if prices do get to $100 a barrel or maybe a little lower than that.
Francisco Blanch, who is the Bank of America Securities Head of Commodities and Derivatives Research. Thanks so much for taking the time here with us.
Thank you.
Thanks. Coming up, why the greater opportunity still remains possibly in equities, according to our next guest. We'll discuss after the break.
Markets are selling off this morning. All major averages are lower, off more than 1%. You can see the Dow now off nearly 500 points. This comes after consumer prices top forecast for the third month in a row. And now investors, they're worried about the path forward for interest rate cuts. Many traders pushing off that first rate cut here from the Fed. We want to bring in Penny Pennington, Edward Jones, CEO, to discuss more. Penny, it's great to have you at the desk today. Let's talk about that CPI print, the third month in a row, like I just said, of a print that shows that consumer prices remaining elevated here, much stickier than what the street had been forecasting. What does that then tell us about the pressure that we could see on equities in the short term?
Yeah, well, let me zoom out for just a moment and say that our financial advisors are meeting with our clients right now. 8 million clients who we serve. They meet with 500,000 clients each week. So you're right to ask what investors and what our clients are thinking about. What they're asking about right now is, what does this do to my medium and long-term plan? How do I think about the goals that we put together, my financial advisor and me and my family? How do we think about that in light of what is likely to happen, which is what the Fed has been conveying, higher interest rates for a little bit longer? CPI inflation is pretty sticky right now. We saw some good moderation, right? We saw some prices come down. We've seen other prices go up, especially the things that our clients are spending money on. Larger ticket items. They're spending money on experiences. One of your previous guests talked about how this summer is going to be a busy travel summer. So those kinds of sticky prices on the in the service sectors are affecting the way clients are spending their money right now.
Does it affect the way that they're saving as well, or how much of their savings they're tapping into?
Sure, it does. I mean, one of the things that we're seeing that's very interesting is that retired investors, the investors who are watching your show, they're spending on bigger ticket items. They're taking their families and 3 generations of their families to Italy or on that dream vacation.
Do they need a friend? They could take me. Just saying.
So the way that they're spending and investing is affected. One of the things that they're asking is, should I be getting the kinds of returns that we've seen in the S&P 500 since last October? Should I be seeing 25% returns in my portfolio? Well, only if that's the risk appetite that you have. Only if your goals are longer term in nature, but we're talking to our clients about shorter term goals, balancing those with longer term goals, and so what this means for their spending and their saving, short, medium, and longer term.
Does this at all change the underpinnings here of the bull market? Does that at all make you question just in terms of the upside that we could see here at this stage of the cycle?
Well, this has been quite a frothy market. We do expect volatility. Volatility is created by this kind of CPI report. It's also, frankly, created by what's going to happen in terms of the election environment for the rest of the year. So it certainly has an effect on the way that we think about a strong stock market. We do think that while volatility is going to be there, that there's still room for this to go. The fundamentals are strong. Clients are getting rewarded now for fixed income investments. It seems that the goodness in the stock market seems to be broadening out a little bit beyond those magnificent 7. All those things are good things. As interest rates stay a little higher, financial services companies, their stocks remain in good shape.
You know, when you think about some of your clients and the propensity to either crowd into risk assets versus crowding into overcrowded trades, ones that are just super popular and seem like they make a lot of sense because everybody else is doing. Where do you see that balance playing out right now?
Wow, that is the benefit of having a financial advisor. To take some of that emotion and take some of that FOMO out of it, FOMO or YOLO out of it, right? To really bring the conversation back to what's important to you. What's important to you as a client, what's important to your family. The benchmark that really matters for your investment returns is your own benchmark as it relates to your goals, how long you have to achieve those goals, and the risk that you that you want to take. So we talk to our clients about what sorts of investments they ought to be in and the allocation of those investments. And every single one of those conversations is hyper personalized to that family.
When it comes to those that maybe have a longer term horizon, are you still encouraging them to take a bit more risk, to still bet on some of the names that had outperformed leading up to what we saw over the last couple of weeks? The fact that maybe you do see them potentially regaining some momentum.
Yeah, fundamentally, the longer you have, all things remaining equal, the more risk appetite you ought to be prepared to take. And so yes, but that's a very personal thing. But yes, we do see more to run on the equity side, and that's a place to be allocating investment right now.
Penny Pennington, Edward Jones CEO, thank you so much for taking the time here with us today.
Pleasure to be with you.
Absolutely. Everyone, let's take a quick look at the major averages here. Shauna, we're tracking the markets at session lows as of right now. The Dow, the S&P 500, and the Nasdaq all in the red. The Dow is down by about 1.3%, S&P 500 down by about 1.1%, Nasdaq Composite tech-heavy average down 1.1% as well here. And Shauna, we've been keeping tabs across a lot of the sectors and the big moves to the downside here. When we started the session, all 11 sectors were in negative territory as well here.
They certainly were there. You're seeing the pressure across the board, and this comes as a number of Wall Street pros are starting to readjust their rate cut expectations for this year. When you take a look at Fed Fund futures, obviously we have seen a huge shift in terms of the likelihood, or it's very unlikely at this point, that at least they're losing confidence. Maybe that's a better way to say it, that we are going to see the Fed cut in June. A couple of quick reactions out on the heels of this print. Morgan Stanley's economist there, led by Ellen Zettner, she's now just calling into question the likelihood that we are going to get that June rate cut call. Then when you take a look at the recent commentary out of Capital Economics, Paul Ashworth there was just saying that this print actually kills a June rate cut hope here. So again, you're seeing that reaction play out in the broader market. You have stocks right around session lows.
Absolutely. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. With Tesla's recent volatility, Wall Street is beginning to get a bit concerned. Now, two analysts are expecting a decline in sales, with Alexander Potter of Piper Sandler expecting deliveries to slip 0.5% to just shy of 1.8 million vehicles, while Philippe Houchois of Jefferies foresees... Thanks, I tried. Foresees roughly a 3% drop to 1.77 million. Both analysts also cut their price targets to $205 and $165 respectively here. So a little bit more bearishness entering the chat here on Tesla right now.
Yeah, not exactly a huge surprise. We know Tesla has been a massive underperformer, to say the least, since the start of the year. The worst performer within the S&P. We have certainly seen an entire shift just in terms of how investors view this stock and how they have viewed the stock over the last several weeks. And some of the criticism surrounding Musk, at least most recently, about what he was saying for robo-taxi and what that's going to do with Tesla, is that's just a sideshow. He's doing everything he can. It's part of the playbook that we've seen before, trying to distract investors from some of the concerning trends that we are seeing in terms of sales and the decline in sales that we could potentially see here in the coming quarters. And he's trying to shift that focus to that next new shiny object, and this could be robo-taxi. It was interesting what Jefferies had to say about robo-taxi, because they did acknowledge that, yes, it is helping sentiment, but they do have some doubts surrounding robo-taxi and fundamentally what it's going to do to the investment story, at least in the near term. And then you compare that to what we heard from Piper Sandler. You got quite the look on your face.
I mean, this is just April to forget for Tesla.
It
started off with
2024 to forget for Tesla.
Yeah, that's true too. Wells Fargo, they started things off. They saw moderating delivery growth driven by lower demand, diminished return on price cuts, estimating the auto gross margin excluding credits would fall by 130 basis points year over year in Q1. So yeah, this is not a good year so far.
Not a good year. But Jefferies did point out a silver lining, though, within their note there. Piper Sandler pointing out that silver lining within their note, saying that they are confident that Tesla is going to be able to overcome demand issues by 2026.
Okay.
So if you got that longer term investment horizon, if you're able to withstand some of the volatility that we could see over the next 18 to 24 months, you could be looking at a strong 2026.
Yeah, as a friend of mine would say, grab a snack and come right back on this name, perhaps.
All right, well, coming up at the top of the hour, Madison Mills will be joining me here on set. We are going to continue to break down the stronger than expected CPI print, the pressure that we are seeing across the board. And then we also have two companies in our tech spotlight, TSMC and Apple. We will give you the latest on Taiwan Semi's AI play and Apple's iPhone production.
Plus, we got the lowdown on which Made in America brand is giving Nike and Adidas a run for their money. I know us Americans say Adidas. But anyway, I'll also be back here at 11 a.m. for Wealth, where we're going to dive into how inflation could be affecting your pocketbook, your purse, your wallet, whatever is in there. Plus, why do we even care so much about earnings? We're going to break that down for you. Yahoo Finance contributor Ross Mack going to break down the reason for the season. Stick around. This is Yahoo Finance.
Welcome back to Yahoo Finance. I'm Shauna Smith alongside Madison Mills, and we're 30 minutes into the trading day. Stocks, they're selling off this morning. The big news driving the market today is that March CPI print. So let's get right to it. The three key figures from this report out. And we got to start with shelter, Maddie, because we know the impact that this has had on this report. It remains one of the stickiest sectors, rising 5.7%. We're looking at that on the year-over-year change. On a month-over-month basis, an increase of just about 0.4%. Now, this accounts for over 60% of that 12-month increase. So really putting this report in perspective with how much shelter is really driving that headline number.
A lot of the shelter piece driving that number, but what's not driving it is food. This is one people are feeling every day, of course, accelerating by 0.1% on a monthly basis, and you see 2.2% on a year-over-year basis. But that 0.1% number providing people with at least a little sliver of good news, because it could have been much worse. Obviously, food has been incredibly expensive for folks. I wonder to what extent the Biden administration is thrilled to see that it wasn't higher this month. It was still rising overall, of course, here, but it could have been worse when it comes to food.
Yeah, silver lining there. The Biden administration really looking for any silver linings within this report, given the fact that so many Americans are pressured every day on higher prices, especially when you compare it to what you're paying a year ago, 2 years ago. Let's also round this out with energy and a look at what we're seeing there, because it did accelerate a bit in March, rising just about 1.1% on a month-over-month basis. On a year-over-year basis, it was up just over 2%. The biggest contributor to that rise that we saw on a year-over-year basis was, and really on the month-over-month, is also the gains that we saw in gas. In gasoline, you saw gains of 1.7% compared to the prior month. So we have seen the price of oil tick higher. We have seen gasoline prices rise as a result. So that's a big driver to some of the price increases that we are seeing within the energy sector. All right, let's do a deeper dive into the market action. We mentioned the fact that it was a much stronger than anticipated report here for CPI print, really beating on all metrics when it comes to headline number, when it also comes to the core numbers here. So when you take a look at the market's reaction, you've got the Dow selling off, now off nearly 500 points. And you can see right around where we are trading, we're right around the lows of the session. Flipping over to the S&P 500, that's off about 1% here. And why we're seeing this sell-off is because more and more people on the street are pushing out the likelihood of that first rate cut. Now the market is only pricing in 2 rate cuts before the end of the year. That was down from what we were previously expecting of 3. And then taking a look at the Nasdaq Composite, that's off 1.1% here, and you can see the drop at today's open, and we're off just around 1.1%. Maddie, and I know you're taking a close look at some of the action that we're seeing in yields.
Yeah, it's interesting to see what's going on in the yield space, pricing in a higher for longer environment, as we do see the 10-year just hitting 4.5. It was about just under the 4.5 mark as we started our show. That level kind of teeter-tottering around that level, but that is a key level to watch. Investors are saying in notes this morning that 4.7 is going to be the next key level to watch for the 10-year. If we get to that, that is definitely indicative of traders pricing in a higher for longer interest rate environment. Some other economists this morning saying that we could see signs in the Treasury market, Shauna, of a November cut getting priced in the next couple of days. So that would be obviously a big change, because we've been hearing July, the summer is maybe a live meeting, but it looks like if you look at Treasuries, not so much.
And real quick, just taking a look at the sector action, because I know we started the day here, at least the opening bell, with looking at some of the pressure that we're seeing across the sectors and where we stand right now, 35 minutes into the trading day. We are still seeing energy, the loan sector, that's holding on to gains up just about 0.1%. But no surprise, real estate, utilities, the worst performers in today's trading action. You've got utility sector off just about 2%. Real estate off nearly 3.5%, Maddie.
Those interest rate sensitive sectors really struggling on the day. We're going to talk about all of this and more with Harry Colvin, Longview Economics Director and Senior Market Strategist. He joins us now. Harry, thanks for being here with us. Talk to me about which corner of the market was the most prepared for this upside surprise in the CPI print.
Well, it's funny you say that. I think markets actually have been quite well prepared. Generally, with many people calling for a bit of a wobble in markets, and in fact, if you look at downside put protection in portfolios, that's been picking up generally. So a little bit of a wobble, and it's, as you say, it's towards the sectors you would expect, particularly those defensive bomb proxy type sectors. Not surprisingly, but markets I think have been a little bit prepared for a wobble, which is why I don't think we're going to get much weakness in this equity market.
Can I follow on that quickly, Harry? Because I'm curious about what makes you think the market was prepped for this. We've seen that over the past 7 days, it's kind of depressing for the market because it's the first 7-day stretch without a record high so far this year. We've just had record high after record high. Where in equities are you seeing preparation for a higher for longer environment with that kind of a rally?
Yeah, I mean, look, I'm really referring to this big pickup we've seen in the put to call ratio on the CBOE. Investors protecting their portfolios to the downside, and therefore, because they're protected with options, there's no real selling pressure in cash equities. And as well as that, more anecdotally, there have been lots of commentators out there calling for a pullback in equities. And of course, pullbacks don't happen when everyone expects them. They happen when there's euphoria and complacency and more calls for further gains in equities. So I think in that sense, this market's been quite well prepared for a little bit of weakness.
Harry, the weakness that we're seeing today, do you view this most likely as just a temporary blip?
Yeah, I think this is a little consolidation within an ongoing uptrend. I think we're in quite a low volatility environment. The buy the dip psychology is still working. And of course, rates are rising. Bond yields backing up, the dollar's been strong. There are things to worry about, and I think that's why we've had this pickup in downside put protection. But let's not forget that's been happening all year. Upside surprises in inflation, higher rates, higher dollar, but actually equities have rallied anyway.
So what would be the next catalyst to have this market pricing in a rate cut in November, as late as November?
Well, look, I think we need to start seeing some softer inflation numbers and other evidence that inflation's about to soften. And arguably, we are beginning to see that in some parts of the US economy. If you look at the forward-looking indicators for the labor market, almost all of them are rolling over. Hiring intentions are down. Part-time workers in the service sector, they're falling. That's normally the type of labor that gets cut first before other job losses come through. The number of people working part-time because they can't find a full-time job, that's trending up. You know, if you look at the Kansas City Fed labor market index, that's rolling over, and that aggregates all kinds of forward-looking indicators like new hires and quit rates and things like that. So I think pretty much wherever you look, there is softness coming in this US labor market, and that should then feed through into service sector inflation and into interest rate expectations. So I think that's the key catalyst. That's the key trigger we want to look for over the next few months.
Harry, do you think this inflation print, has that pretty much killed any sort of odds that we are going to see a June rate cut?
I think it probably has. I mean, unless we get some real marked deterioration in some of the macro and inflation type data over the course of the next month or two, then yes, that's looking less likely and probably cuts more of a story for the second half of the year.
All right, Harry Colvin, we appreciate you taking the time to join us here, Longview Economics Director and Senior Market Strategist. Thanks, Harry.
Thanks.
Well, more bad news for the world's second largest economy. Fitch cutting its outlook on China's credit rating to negative from stable, saying that the government could pile on debt as the economy faces increasing uncertainty. Joining us now to explain what this means here for China and for the U.S. and you, the investor, we want to bring in Yahoo Finance's Kiko Fujita. Kiko.
Yeah, good morning to you, Shauna. We didn't necessarily see a significant reaction in the markets, partly because we have heard this story before. It was just in December that Moody's downgraded the outlook for China's credit rating. Fitch now keeping China's credit rating at A+, which is the third highest category. But it downgraded the outlook to negative, specifically citing risks to the country's public finances. Now, this is all about this double whammy we've been talking about with China, decelerating growth and then growing debt stemming from the collapse in the country's property sector and then government measures that were spent on anti-pandemic measures. China's debt to GDP ratio climbed to a new record back in 2023. 287% is what we're looking at. You compare that to 97% in the U.S. and certainly points to just where the health is in China right now. And that, by the way, is according to data from the National Institute for Finance and Development. Now, if you look specifically at debt held by central and local governments, you see it on the chart right there. In roughly 4 years, it's gone from 77% to roughly 111%. And there's a number of factors behind that. There's the transition largely in the public finance model, which was driven by local governments that largely leaned on land development. And with the downturn in the property sector that we've been talking about, that development has plunged, leading to unsustainable levels of debt. Now, Fitch notes in this report the central government will now be shouldering a lot of that load or more of that load. And that's the big concern for China moving forward. Now, China's finance ministry naturally denouncing the Fitch downgrade overnight, saying that China's deficit is, in their words, at moderate and reasonable levels and risks are under control. The question is, what's next now that we've gotten the downgrade on the outlook? Well, ING's chief economist Lin Song says Chinese corporate credit could be next to be downgraded, and he expects credit ratings or ratings agencies to eventually downgrade the actual credit rating, largely because fiscal spending is expected to only accelerate as China tries to stabilize the economy there. Now, last time we saw a wave of credit downgrades was back in 2017 for Moody's and S&P, 2013. When you look at Fitch, there are questions, guys, though, about the appetite for stimulus. Now, there's so much comparisons that are made between what's happening now and back in 2008 in the midst of the financial crisis. China at that time put forward a stimulus of $585 billion. The thinking is this time the appetite isn't there for that, largely because that 2008 stimulus was about development and property development. That's largely the reason why China is in the position that it is today with the incredible amount of debt they have taken on. By the way, IMF now estimating growth in China to be at 4.6%. So that points to slower growth with this debt picture and China potentially having to take on more debt in order to stimulate the economy from where it is right now.
It was a very challenging time for China, at least it looks like in the near term. Kiko, great stuff. Thanks so much for breaking that down for us. Well, stocks selling off this morning. Again, you've got the Dow now off just around 431 points, so off the lows of the morning session. The S&P off just around 1%, as well as the Nasdaq. The move lower coming on the heels the CPI print that we got out this morning, showing that for the third month in a row, consumer prices remaining elevated, coming in hotter than what the street had been forecasting. That's putting pressure on the major averages. When you take a look at the bond market, we are also seeing some movement there. You've got the yields spiking here on the heels of this report. On the other side of this break, we're going to zero in on the tech sector, one of the leaders of the massive rally that we had seen in the market up until this point. What we could expect on the other side. Well, Nvidia is one of the outliers in today's session, bucking the broader market selling action. And you can see gains of just about 1%. And it hasn't been an easy road, though, for this AI darling in the recent weeks, because the stock actually sold off after it hit an all-time high of $950. That was back on March 25th. Shares since then have fallen about 10%. So here with more on what the road ahead could look like, we want to bring in Gil Loria. He is D.A. Davidson Managing Director. Gil, it's great to talk to you. So we don't want to make too much of a 10% drop, especially for Nvidia, given the fact that we have seen this massive run up over the last year, a massive run up even since the start of this year. But when you take a look at some of the technical levels and the pricing action that we've seen in Nvidia, what does that signal to you?
That Nvidia is caught between two very strong forces. This year is going to be a spectacular year for Nvidia. They only have 5 large customers that represent more than 2/3 of their revenue, and all those customers are telling us in the street that they're going to buy a lot more GPUs this year. So there's a lot of comfort that Nvidia can exceed its expectations this year. That's one big force. The other big force is that there are many technology trends and market trends that are indicating that this won't last for very long, that by 2026, Nvidia's revenue may not be higher, it may actually be lower than it is this year. So somewhere between those two forces, the stock is caught, and that's why it's become so volatile.
Why do we think 2026 is the end for Nvidia?
Not the end, but a normal cyclical downturn. Nvidia has massive share in this market that's absolutely exploded, but its customers are even bigger companies. So Microsoft, for instance, represents 19% of Nvidia's revenue last year, and their spend on GPUs was almost 40% of their CapEx, of Microsoft's CapEx. That means their CapEx went from 12% of revenue to 17% of revenue. If that was to sustain or grow, which is what's implied in Nvidia's estimates, Microsoft would lose 5 points of margins over the next few years. That's highly unlikely. It's unlikely that this level of investment from these large customers will continue, especially as they develop replacements for Nvidia's chips. Microsoft, Amazon, Google are developing their own chips to replace Nvidia.
Yeah, and Gil, I want to talk to you a little bit more about that, because clearly Nvidia is seeing more and more competition, and it seems to be, and it is coming from even some of its own customers. So what pressure, or how much pressure do you see that potentially placing on margins, or even just restricting some of their pricing action then in the years to come?
Well, that's the thing. Not much this year. This year, it's still all going to be Nvidia. For all these customers, they're buying as many GPUs as they can put their hands on. But within a year or two, they're going to have production at a level that they can support their own demand. And importantly, they can reduce costs very significantly by using custom chips that are only there to do training and inferencing for AI. Those are far less expensive chips than GPUs. GPUs are extraordinarily expensive because of how versatile and competent they are. It's like driving to the grocery store in a gold-plated Ferrari. You don't need that. A Tesla Model Y will do the trick, and that's what Microsoft, Amazon, and Google are developing in-house.
Okay, but having said that, in terms of the Ferrari versus the Tesla there, I wonder to what extent new car makers are going to come in and disrupt what we see going on with the Nvidias of the world. We already have Intel announcing new chips, Google announcing new chips. To what extent are those competitors prepared to really take some market share here?
So the large hyperscalers already have products. Those will ramp up pretty quickly over the next few years. In terms of upstarts like Grok or others, that'll take longer. That'll take just because chips are very hard to make. It takes a really long time to master that process. But there's a wave of new chips that were built specifically and exclusively around how generative AI works. Those are going to be far better and less expensive, and I'd expect those to ramp up into more the 3 to 5 year time frame.
So good, when we talk about the fact that at least when you're taking a look at the longer term timeline, we could see a little bit more pressure from these competitors when it comes to Nvidia's business. Who do you think is best positioned outside of some of the customers that we already talked about, turn to competitors maybe here in the future? Who do you think is best positioned in order to really capitalize on the AI spending and momentum within the space?
So I do think it is the hyperscalers, because they're the ones that are actually using these chips to provide a service, and that's not going to stop. There's going to be a continued ramp of activity, training and inferencing on generative AI. So it is first and foremost Microsoft, which is getting a lot of credit, justifiably so, but also Amazon. Let's not forget AWS is bigger than Microsoft Azure, and they're just getting warmed up in terms of their ability to provide generative AI services to their customers, which they have more of. And Amazon, by the way, to tie this back to the chip conversation, when they just made a big investment in Anthropic, $2.75 billion, part of the deal was that Anthropic would run on Amazon chips. So Amazon is setting itself up to be vertically integrated here and provide these generative AI services at a much more competitive price. They're getting some credit, but not nearly enough.
Gil, to what extent should investors be worried about valuations for some of the names you just mentioned?
So Microsoft is trading closer to the top of its valuation range, which it deserves to, because it's a much better company than it has been for the last 25 years. Amazon is trading a little bit above average, but still not at the high end of its multiple range. And so there's a little bit more opportunity there. And to circle back to Nvidia, it really hinges on what you take for 2026 estimates. If you use the consensus estimates from the 60 or so analysts that have estimates out there, Nvidia is not very expensive. If you use our estimates, which is less than half of that, they do look very expensive.
All right, Nvidia, mixed picture on how pricey that name is. Gil, thank you so much for joining us. Gil Luria, I really appreciate it.
Thank you.
Now, Apple's iPhone output in India is ramping up. A new report from Bloomberg suggesting 1 in every 7 iPhones is assembled in India. That would total about $14 billion worth of output there. With more, we have Yahoo Finance's Dan Howley joining us. Dan, what is this output from India telling us about maybe diversification away from China?
Yeah, Maddie, that's really the main story here. I mean, there's two elements to it here. It's the diversifying away from China, ensuring that, you know, should anything go sour between the U.S., I guess more sour between the U.S. and China, that Apple has a manufacturing hub that it doesn't have to, you know, kind of tiptoe around. And so China could be that, so could Vietnam and other countries. But in addition to that, it's part of Apple's strategy of being able to physically have a footprint in the country as far as retail sales go. So they opened up their first flagship store in Mumbai. Tim Cook was there. And so this is something that the company is heavily leaning into. And so just to put that $14 billion into perspective, that 1 in 7 iPhones, in Q1 alone, the company sold $69.7 billion worth of iPhones. And in 2023, it had $200.6 billion in iPhone revenue. So it's still a relatively small number of iPhones being built in India. But if you look on Apple's website, if you look on different job boards, there are plenty of jobs open for Apple in India. So you can only imagine that they're going to continue to try to woo some companies to help them build out in India. That includes Foxconn, Pegatron, those contract builders for Apple, as well as Indian Prime Minister Modi.
All right, Dan, thank you so much for joining us. Looks like Apple is part of the overall downturn we're seeing in the market today, down nearly 1% here. Thanks so much, Dan. We're going to have all of your markets action ahead here. Looking across the board, still seeing declines across all the major indices. Within the Mag 7, it looks like Nvidia, one of the only darlings of the day, up a little over 1% as investors look to buy that pullback. As we continue to see dollar strength increasing today off of that hotter than expected CPI print. We're going to talk all things currencies. That is coming up right here after the break. We're seeing the dollar rising this morning on the back of that hotter than expected CPI print, up a little over, it's looking like 0.8% here. But our next guest saying that the doubts for rate cuts combined with political risks could suggest that the stronger for longer dollar could remain. We're going to bring in Jane Foley, head of FX strategy at Rabobank, to discuss. Jane, thank you so much for being here. To what extent do you anticipate this stronger for longer dollar having legs here, given some of the risks that we see out there geopolitically with the election? How long could this last?
I think this could last for quite some time. I mean, if we look at the US economy, it's certainly a lot more resilient than other major economies. I'm focusing here particularly on Europe, but certainly if we look at China, if we look around the world, we see a lot of weakness elsewhere. And so you have this point of time where the market consensus is quite strongly in favor of an ECB interest rate cut in June, whereas every week it seems that more data from the US is chasing away at the possibility of a spring or even a summer rate cut from the Federal Reserve. So that in itself, interest rate differentials is favoring the dollar. But as you mentioned it, there are geopolitical concerns. They have had an impact on market pricing, certainly last week. Certainly if you look at what was happening to gold, oil last week, they could come back. They could create some safe haven bid for the dollar too. But also, if you look after the US election, particularly if we had, for instance, a Trump presidency, if he were to introduce those tariffs that he's warned about, well, that could be inflationary for the US too, putting tariffs on the prices of various different goods. And that could mean that the US's or the Fed's easing cycle could really be quite short-lived compared with some other countries. And that too could sustain the dollar being stronger for longer.
Short-lived, Jane, what you were just talking about with the easing cycle, what more specifically do you think we could potentially see?
Well, I mean, clearly that's going to very much depend on the data. The Fed have made it very clear for quite some time that they are data dependent, and they still are. But I think what they were hoping for in today's US CPI report was perhaps some evidence that the stronger inflationary impulses that we've been seeing over the last couple of months, perhaps they were just bumps in the road. And in fact, the fact that we got a stronger number today means that maybe these aren't bumps in the road. Maybe inflation is just much more stickier than they hoped it would be. Now, before the summer, we will, of course, have more US data. But even if we look to that payrolls report that we had at the end of last week, if we look at that earnings number, 4.1% year on year, well, that's not particularly conducive to a 2% inflation target. So it is quite difficult to put the arguments together now to suggest that the Fed should be cutting 3 times this year. Those arguments are looking, quite flaky right now. We really would have to see some concerted weakness in all of the other US inflation indicators between now and the summer for the Fed or the market to be confident that they can really go 3 times this year.
Jane, I'm looking for evidence in this market that we're seeing a repricing of November for the potential first go at the Fed cutting rates. Within the FX space, what would you be looking at to indicate that the market is pricing in November as the first cut?
Well, of course, first and foremost, we must look at the economic data, and there's an awful lot of figures between now and November. In fact, there's a lot of data between now and September, which could, push us in either direction. But clearly the market is taking on board the risk that this resilience of the economy, the resilience of or the stickiness of inflation could continue. But as we get to November, well, we do have the election there, and that's politically difficult for the Federal Reserve. They won't want to be seen as being politically motivated. That could impact their credibility. So November is a difficult time. So possibly, you could make an argument that if they can't cut by September, if the economic data isn't weak enough by September, well, maybe they won't be able to go until after the election. Now, that is not a consensus view right now, but it is out there. It is beginning to be discussed.
Do you think the odds of that are more likely on the heels of this print, clearly?
Yeah, the odds have certainly increased of that on the heels of this print, but it is right now still only April. We are generally still looking at March data, so we have a lot to digest between now and the summer. But certainly that the odds of that have now increased.
Jane, talking about the implications of the stronger dollar, some of the critical levels that you are specifically watching when it comes to that trend that we've seen upside to the dollar, what are they? And talk to us, for our viewers, for our investors out there, about why it's so critical, obviously, that they do pay close attention to the price of the U.S. dollar and the implication here for multinational companies.
Well, that's a very interesting question and can be answered in several different ways. But what I would say is, for instance, if you look at the European Central Bank, the European Central Bank will not be as worried about the relative weakness of the euro today in the same way that it may have been 6 months or 18 months ago, and that's because inflation is far more under control in Europe now. Now, a weaker currency is clearly an inflationary impetus. It brings that with it because it brings in higher import prices. But if you're looking at inflation being much lower, if you're looking at economic weakness, like the ECB, certainly is when it looks at Germany, well, the weaker currency will not be so much of a risk to its policies. And that's why the market consensus is still very much in favor of a June interest rate cut from the ECB. Now, clearly, if the dollar carries on strengthening, if euro dollar, goes down more this year, to 105 or even lower, well, yeah, that may have an impact on the pace of interest rate cuts, but it's not the threat. The currency weakness is not the threat that it would have been a while ago. That said, if we look at dollar yen, it's at 152. The market is very frightened that will bring in some FX intervention from the Ministry of Finance. And certainly, I think between these sorts of levels at 152 and 155, the risk of intervention just to stabilize that currency, to keep the yen from weakening too much, does have to be considered. There is a very strong risk that the Ministry of Finance will intervene to try and prop up the yen.
Well, and it's a great point that Shauna brought up about kind of the spillover effect of economic data like this in the U.S. globally. Since you mentioned the dollar yen, I want to talk about the yen breaking through that 152 level. And you mentioned this as well. How likely do you think it is the Japanese authorities are going to want to intervene now that we've broken through that key level?
Well, I don't think they would ever have gone immediately after that level. They're understanding that the market was very much focused on that level because that's when they've intervened before. But, I think between 152 and 155, that the risk does go up. But FX intervention is not without cost for a monetary authority. And the cost could come both in financial, but also in terms of credibility if the intervention fails to turn a currency pair around. And so I think what the Ministry of Finance the Bank of Japan will be waiting for is hopefully some stronger economic data from Japan, maybe from the April 26th Bank of Japan meeting, maybe a little bit more hawkish commentary, because if that happens, the ideal situation for the Ministry of Finance is that will help stabilize the yen. They will not have to dip their toe in with any more than verbal intervention. So the next few weeks, I think, are going to be really critical for the Japanese authorities.
All right, Jane Foley, appreciate you hopping on with us here this morning, head of FX strategy at Rabobank. Thanks so much. Well, Treasury is jumping after hot inflation data, dashing investors' hopes of a rate cut coming anytime soon. We will dig into the bond market and the moves that we're seeing here on the heels of this print on the other side.
The hotter than expected CPI report pushing Treasury yields up this morning. I want to take a look at what we're seeing specifically in the 10-year, hitting that 4.5 handle, which we've been calling a key technical level for the 10-year here. And as you can see, what is this bump up here? That is, of course, our hotter than expected CPI print hitting at 8:30 a.m., pushing up the 10-year to that 4.5 level. Investor notes this morning and some conversations I've had saying that 4.7 is the next key level to look at when it comes to the 10-year. Also taking a look at the 30-year yield, that's hitting a little over 4.5 here. We also have the 5-year note, so the really seeing movement across the curve here. I also want to transition a little bit because we're not just seeing the strength in the Treasury market, which indicates a higher for longer environment. As we were just saying, we're also seeing strength in the dollar here. You can see here as well that push upward when it comes to that CPI print. So you can really see evidence across the board here, even if you take a look at something like the VIX up this morning. And then, of course, within the Treasury space, seeing investors pricing in this higher for longer environment. And Shauna, as I've been mentioning throughout the morning, I'm looking ahead to when we might see investors pricing in not only less of a chance for rate cuts in the fall, in the summer rather, but whether or not we might see investors starting to price in November as the first potential chance for the Fed to cut rates.
Yeah, the likelihood of that certainly rising after today's print, and we have seen the shift in terms of the Fed, or in terms of what traders are pricing and when the Fed is going to cut its rate first. All right, well, let's talk about that move, Maddie, that you were just mentioning in the 10-year yield, because touching that 4.5 level, the first time that we've seen the 10-year Treasury touch that level, the yield there this year. We want to bring in Kelsey Barrow, JP Morgan Asset Management Fixed Income Portfolio Manager. Kelsey, it's good to see you. So just first your reaction to this move higher that we've seen in yields. And now that we're at that 4.5 level, Maddie was just mentioning 4.7 could be that next level to watch. What do you think?
So it's been a large move today, but it's also been a rational move. So the Fed has been holding on to the idea that they could cut as soon as June and they could deliver 3 cuts this year. And that path to that outcome has narrowed a lot. And as a result, the market has priced out the number of rate cuts to less than 2. But I think that right now we're dealing with some extremes. So if you look back to Q4, that was an extreme. Inflation undershot what the trend was, and the market way overpriced the number of rate cuts. They were pricing as much as 7 or 8 rate cuts. Now we're testing the other extreme. These extremes tend to create opportunities for investors. So if you were looking for that entry point to lock in yields, you found another one today with this move higher, particularly in the front end.
Right, I was just going to say, where is the best entry point for investors? So you're thinking 2-year?
Yeah, the 2 and the 5 and the 10-year, that intermediate part of the market. And I think the other thing that we're really focused on right now is not so much the path of the Fed, but it's the strength of the corporate fundamentals and the balance sheets of companies. And so the primary place that we're focusing our risk budget in fixed income portfolios is actually on the credit side and a little bit less on focusing on the day-to-day of what the Fed is going to be doing. Will they cut in June? Will they cut in September? Will they cut in December? The key, though, is that even though we're pricing out rate cuts, we're not talking about restarting rate hikes. And that's really important for investors right now. Yeah, we're talking about the Fed delaying, but we're not talking about a regime shift where we're talking about rate hikes again.
So the Fed does move sideways from here, meaning that they don't cut, but they're also not raising. So we're in this higher for longer environment right now. Do those trades then still make sense if we don't get a rate cut before the end of the year?
So I do think it still makes sense. So right now what we're doing is we're looking at building fixed income portfolios that are relatively high quality but still can significantly out-yield the U.S. aggregate bond index. So if you look at the U.S. aggregate bond index, the yield is around 5%. It's probably a little bit higher after today's move. We can look across the universe, not just treasuries, not just the very high quality stuff, but corporates, high yield, and build a portfolio with the yield around 6 to 7%. And even if yields just stay around here, the return in your fixed income portfolio should generally match the yield on the portfolio, assuming we're kind of in a stable range. So we do think it makes sense. The pushback we hear a lot is that credit spreads are really tight. So that incremental compensation that you're getting for buying corporates versus treasuries is small.
We would say, yes, it is, but it's justified for the fundamentals. And if you look at other time periods where the economy was equally as robust, you saw similar periods where spreads stayed tight for a long time. And then those periods, it's best to stay invested in the market and collect that carry, clip that coupon, and get that income.
Well, you mentioned kind of investment grade corporate bonds. For investors who are seeing a sell-off in equities like we're seeing today, is that a better way to own some of the names, like a big tech name, for example, to avoid some of the day-to-day dips that we might see in equities that are natural after some of the whipsaws and volatility that we're seeing in the data?
Yeah, so absolutely. I think you want to focus on diversification in your portfolio, things that are going to keep you invested. And when you see a move like we did today, where the 2-year is up 20 basis points, that's probably a 1.5 to 2 standard deviation move. The key is not to get paralyzed, is to think about what are the next opportunities. And what we've noticed is that there is still a lot of money in cash right now, over $6 trillion in cash sitting in money market funds. And typically what happens is once the Fed starts cutting rates, you see that cash pour out because they're no longer receiving those same very attractive yields and chase returns in other asset classes. So right now, this is an opportunity to get ahead of ultimately what we think is going to be the next move being a cut and diversification out of cash into other assets.
Kelsey, when you take a look at the CPI print today, we're going to get PPI tomorrow. What are you expecting to see from that, given what we saw just last month, not too long ago, in the PCE print?
Yeah, no, so that's a really great point, because the Fed's target for inflation, the way that they assess inflation progress, is using the PCE, not the CPI. So the data we got today was CPI. Tomorrow we get something called PPI, the Producer Price Index. And with the combination of the CPI and the PPI, we can project what we think PCE is going to be, which again is what the Fed is ultimately looking at. Now, there's a lot of wrinkles to this story, but essentially PCE, which is the Fed's preferred metric, is running 100 basis points or 1% slower than the pace of inflation in CPI. So we have part of the story right now, but we don't have all of the story right now. And some of the categories that have been particularly hot in the CPI, the one I would point to is auto insurance, which is running around 20% annualized rate. That does not translate into the PCE. The way they measure auto insurance, this is a little wonky, but it's different. And that's one of the reasons why you're seeing this wedge between CPI and PCE grow.
Makes a lot of sense, and great job explaining it, because I think a lot of people don't understand the nuances and the differences and why there is that 100 basis point gap, like you were just talking about, between the CPI print and the PCE print, and then what exactly that means for the Fed's possible next move. All right, Kelsey, great to have you on set. Thanks so much for coming in today.
Thank you.
Well, coming up, our very own Brad Smith. He took a quick trip up to Boston, always on the move, and spoke with the CEO of New Balance. We've got those details for you and part of that conversation when we come back.
New Balance is back and taking on heavyweights like Nike and Adidas as the sneaker battle, as always, continues to be hot. Our very own Brad Smith took a trip to Boston to speak with the New Balance CEO and President Joe Preston. They talked about how his company is innovating to keep up with the competition for this week's Lead This Way. Brad, thank you so much for joining us and bringing us this fantastic piece. Talk to me about what the biggest takeaway was for you.
I mean, the biggest takeaway is that New Balance is back. I mean, this is a 1909 founded company. It was purchased by Jim and Ann Davis decades later. And what they did was they essentially said, this is more than shoe insoles. This is all about putting a shoe, putting a silhouette around the insole that they were known for. That was the business that they purchased. And for Joe Preston, trusting him with stewarding this company forward into the next generation. It's a company that, of course, had to capitalize on Taylor Swift wearing the latest iteration of the retro shoes around, one of the major silhouettes that took off last year. It's a company that's seen a rise in popularity among the silhouettes that get purchased on resale platforms as well. StockX, Goat Group data that we've even seen has seen them in the top 16 selling silhouettes repeatedly, and especially over the course of the last year. And I think one of the findings that I was really able to take away from the conversations with Joe was really just based around how he is capitalizing on these moments where we're all talking about the dad shoe, the dad hats, the dad bodies, the Call Her Daddy podcasts, all of those things and more, and making sure that New Balance is at the center of the conversation and also continuing to push the envelope with even more research. Some of that research and innovation you're going to be able to see within this clip right here.
This is our Smash Lab, and this is a brand new facility that was built within the track. It's our new innovation center, and this helps to test the resiliency of the midsole. It helps to test energy return, and it's used throughout the development process to make sure that we have the optimal amount of cushioning in the midsole.
How many times do you kind of have to go back and forth to say this is not enough of the bounce that our users, our runners are looking for?
So we have this, and then we also have wear testing.
Yes.
So we have athletes that are wearing the product and everyday runners that are wearing the product, and we take that qualitative feedback, we take it with this quantitative feedback that's fed into our developers.
What is that next chemical compound that you're really experimenting with now that gets you excited about the future for New Balance?
We do believe that the next big revolution is going to come in materials. I fundamentally believe that, and I think it'll come plant-based or something that will revolutionize the industry.
So you saw that bounce right there, that was really showing the disbursement of the materials that go into the sole of our shoe and give us that rebound. What is that feeling that you look for when you go for a run, Shauna, for instance?
I would love, you're never going to turn down any sort of bounce. I have never, though, run in New Balances. I was going to say, I have to try that out after seeing the Smash Lab and exactly what you could see here in that sole. But I think you're always looking for comfort. You're looking for something that gives you an extra spring in your step. And I think that is what New Balance needs in order to capture more of those athletes. And you were just mentioning before we went to air that they have a number of key partnerships with athletes who have had a tremendous year that's going to help sales.
I mean, go down the list. You got Coco Gauff coming off of a U.S. Open win last year. You've got, of course, Shohei Ohtani, now the largest MLB contract that we have seen, New Balance. You can go down Sydney McLaughlin, who's going to be participating and competing and representing Team USA in the Paris Olympics this summer as well, who is already a gold champion medalist as well for the U.S. in the relays. And so she's got an exclusive partnership. I had to pick up some of those shoes for my own significant partner. So making sure that we got in on that special.
And Brad has his New Balances on right now too.
Rocking the kicks.
Lift them up. There you go.
And if you watch the video, you can see Brad running at an all-out pace while conducting an interview. So I highly recommend folks watching that, Brad. It was a sight to see. Thank you so much for joining us, and of course to Brad and the great production team behind him on this piece. Stay tuned for Brad's full interview with Joe Preston. That's coming out tomorrow at 10:40 a.m. Eastern. You won't want to miss it.
Let's do a final check of the markets here. Again, we're still looking at some losses across the board. Getting back to the headline story of the day, CPI print coming in hotter than expected for the third month in a row. We are seeing selling across the board for equities. You got the Dow off the lows of the day, still down just over 400 points. Nasdaq and the S&P both off just about 1%. More on the selling action that we are seeing and also the spike that we are seeing in yield. Coming up next, our brand new show, Wealth, dedicated to all your personal finance needs. Brad Smith is going to head from here to the studio. He's got you for the next hour. Stay tuned.
Welcome to Wealth. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. And we've got a big show and big story for you today. Stocks are plummeting right now after a hotter than expected inflation print spooks investors. Take a look at the Dow, the S&P 500, and the Nasdaq, all in negative territory. The Dow down by 1%, S&P 500 and the Nasdaq the same on a percentage basis. This comes after we've seen the CPI print come in and complicate the Federal Reserve's decisions around interest rates, putting Wall Street on edge. We're going to break down what the report means for you and your money. Well, let's start here with equities. A red-hot sell-off, as we mentioned, stocks falling after a third straight hotter than expected inflation print as price pressures remain persistent on the U.S. economy. Yahoo Finance market reporter Jared Blickery is here to break down all of the action. Jared, walk us through what's going on right now.
Sure. Thank you, Brad. First, we're seeing a huge spike up in yields, and we'll get that to a second. But first, I want to show you all the red we're seeing in the U.S. right now, and small caps leading the way down by 2.5%, arguably more sensitive to the rate situation, and also a surging dollar. And let's get to that right now and just cut to the chase. Here's the U.S. dollar index. Hard to see right here. I'm going to put some candlesticks up, but this is a big day, and you can see now we are tapping on the highest levels in since about last November, December. There we go. I'll put a line chart so you can see that a little bit better. And then let's go to the 10-year T-note yield because that is advancing by 13 basis points. That is a huge move. You can see this is a one-year chart. The trend is up here. And now we are at the 4.5 big psychological level. So we may pause here, but now I think traders going to put 5% back in their sights, and we'll have to see what happens there. As a general rule, higher rates, they tend to weigh on those longer duration stocks. Now, here we see real estate and utilities taking the biggest drops. Real estate down 4%. That is very sensitive to these higher rates. Utilities, same boat there, but we're also seeing consumer discretionary, tech, materials down by more than 1.33%. Only energy in the green here, and that's despite WTI crude falling a little bit after a slightly bearish weekly DOE report. Now, here are leaders, a little bit more color here. PSCE is a small oil ETF. That's small cap oil. That's also in the green. Cannabis barely in the green, but for the most part, lots of red. And the dark red, 4.57% to the downside. That is a Korean ETF, EWY. That is a leader for the chip space. So we want to keep an eye on that. Solar energy, that's TAN down 4%. Regional banks down 4%. And home builders down about 3%. And we can really see what's happening inside the semiconductor market here. Now, Nvidia, the perennial, we can catch a bid here, up 1.3%. Taiwan Semi was up in the pre-market. But for the most part, we're looking at a lot of pressure around U.S. equities, guys.
Hey, Jared, just while we have you here, can you take a look at Bitcoin or cryptocurrency more broadly? I just want to see how some of the riskier parts of the asset space are doing right now.
Yeah, well, in the past, Bitcoin has reacted as a multiple of whatever U.S. stocks are doing, but we're not seeing that today because Bitcoin is only down about 0.8%. Let me give you the 5-day view, and really not too much of a hiccup this morning when we got that report around 8:30. We did see a little bit of a drop, but within the context of the larger moves in Bitcoin, not really much. And also, I should say that we've reclaimed the prior levels. So right back to where we started from before that report. So Bitcoin really shrugging this off. So interesting to see that dynamic at play as well.
Yeah, really interesting. A lot to continue to track. Just coming into my inbox from BlackRock's Rick Reeder, today's much anticipated CPI report, much greater detail on the current inflation picture. Importantly, what the Federal Reserve is most focused on upon these days. Unfortunately, it's hard to see it as anything other than a setback, he says. Jared, thanks so much for taking the time here to break down the market activity. Well, Americans plagued by surging prices over the past 20 months continue to face strain as the cost of meeting everyday necessities remains stubbornly high. The Labor Department's most recent CPI report showing that the price of everyday goods rose 0.4% in March, with rising shelter and gas costs driving over half of the headline CPI increase last month. So, what types of impact do these prices have on your everyday finances? Yahoo Finance reporters Danny Romero and Molly Moorhead have more. Danny, let's start with you. Talk to us about some of those high shelter costs you're tracking.
Brad, housing costs remain sticky. Shelter inflation came in at 5.7% annually in March, and that's lower than last year in March, where shelter inflation peaked at 8.2% annually. And economists aren't expecting rental inflation to ease quickly anytime soon. So take a listen to PIMCO economist Tiffany Wilding.
The fact that you have just a broader shortage of housing, within the housing market as a result of years of underbuilding since the great financial crisis, suggests to us as well that you will probably settle in at rental inflation levels that were above those of the pre-pandemic period. Rents look like they're going to continue. Rental inflation is going to be sticky.
You can hear it right there that housing costs will continue to remain sticky. But what is currently going on in the rental market? Well, rent prices are increasing month over month, but are down annually. The median rent price right now sits around $1,300, and some regions are experiencing higher rents due to low inventory. And rents increased in 81 out of 100 cities in the U.S., Apartment List reported. But it's a different story in the Sun Belt area, like Austin, Atlanta, and Nashville. They're dealing with price declines. Meanwhile, keeping your home in good shape is expensive. The price to repair household items stayed within range of 18% annually, and that includes things to fix your household appliances, pest control, and basic upkeep like gardening. The cost of electricity also jumped 5% annually, and the rise in energy prices didn't help on that front. So overall, consumers continue to feel the pinch, especially when maintaining a good home.
All right, a major component that factored into this CPI print. Danny, thanks so much. Molly, want to pivot to you. Talk to us about the uptick in energy costs.
Yeah, it's specifically for drivers. It's tough out there also. Gas prices were up 1.7% in March, and that followed a nearly 4% increase in February. Now, in some ways, this is typical. Gas tends to get more expensive heading into the spring and summer travel season. Right now, the average cost of a gallon of gas is about $3.62 nationally. But that is not all for drivers. Auto insurance, which we've talked about a lot, just continues to spiral. It was up 22% year over year from this March reading. And car repairs, also more expensive, up over 8%. Now, if there's any little bit of good news for drivers, it's that the actual cost of cars finally is slowing down a little bit. So the price growth for a new car and a used car, which was really high during the pandemic, that's starting to settle down.
Danny Romero and Molly Moorhead, thanks so much for diving into the details of this data here with us this morning. Appreciate it.
Thanks, Brad.
Well, stocks falling as hotter than expected inflation in March put investors on edge. This is the third hotter than expected report, and it complicates the Fed's next move on interest rates as the central bank works to bring down inflation to its 2% target. Now, the big pressure is on prices. Shelter, that accounted for over 60% of the total 12-month increase in core prices. And energy prices, largely to blame for the rise in headline figure, Americans are paying more at the pump. Here with more, we've got Steve Sosnick, who is the Interactive Brokers Chief Strategist, alongside Chris Versace, Tematica Research Chief Investment Officer. Great to have both of you here with us today. You know, first and foremost, I gotta wonder here, Steve, what went through your mind when you saw this report come out, when you saw the figure drop, and you see the market reaction like this?
Good morning, Brad. Literally, I tweeted my first response, which was just gulp. It was a bit of a stunner because, when you think about it, we really were unchanged on these metrics versus month over month. And remember, it's much more sensible to look month over month than year over year because you want to see where the 1 month of fresh data is rather than the 11 months of old data is. But within a matter of seconds, my thoughts changed to, how can the Fed really consider cutting interest rates in this environment? Remember, the Fed has the dual mandate. Full employment, which we saw as recently as last Friday, still seems to be in place, and stable prices, which we got another reminder today that part of the mandate is not in place. So you don't have the ability to cut rates. The market's adjusted to that. And I think the market was really just not in the mood for an upside surprise in inflation, and this is the result of what we're seeing. And the bonds the bond market certainly is not in love with these numbers.
Chris, I was taking a look at your Twitter or X or whatever we're calling the today profile as well, and you were of the same thinking. I mean, fewer rate cuts than expected coming. So what does the reality of that look like here as we go into now and are in the midst of the second quarter and now staring down perhaps a back half of this year type of cutting environment, if any cuts at all?
So I will say this, Brad, I wasn't very surprised by the hotter than expected print. And if we follow the data, you look at the March PMI reports, input prices, selling prices moving higher. We look at some of the wage data, even comments found in yesterday's March NFIB Small Business Optimism Index, small businesses in particular, struggling with inflation. So not overly surprised, but I think when you look at the data, particularly the core CPI on a year-over-year basis for the last 6 months, it's trapped between this 3.8%, 4.0% range, effectively stalling out from the progress we saw in 2023, the first 6 to 9 months. So I really do think that the Fed is, they're in a very tough position here, and we are seeing rate expectations fall. I've been in the camp that we would probably see 2, maybe 1 rate cut, and I think the market is coming around to that. But remember, Brad, we also have the PPI report tomorrow, and if you look at the trend of late in a number of different commodities, they are higher. That's going to impact the PPI report, and the PPI data tends to lead the CPI by a couple months.
And certainly here, I mean, markets can be upset. They can ingest this data for a period of time and have the reaction like we're seeing right now. But then eventually strategy has to emerge. And Steve, I wonder if there are any pockets of resilience that you're seeing even amid the pullback that we're watching right now.
It was interesting because the market came off its lows today pretty much as Nvidia started to turn higher. So the faithful are still out there in Nvidia, after it sort of had a better, let's call it correction. I think some of that weakness we saw recently in Nvidia had to do with taxes. I think a lot of people who traded in and out of it successfully in 2023 have to pay the tax man on Monday. But reality, energy is what's leading, and that does cause a problem because the rationale for energy leading the market is not a positive one from an inflation point of view, because it means that energy prices are rising. It means that oil prices are up, which they are. One can argue we've put in a relatively medium-term double bottom in the price of crude. And so that's a defensive sector. It's a defensive sector, and B, it sort of is an inflationary hedge in some regard. It's a little dismaying to see that leading, although right now it's a safe haven because most of the big energy stocks pay a solid dividend and add a little bit of ballast to your portfolio. But it's not a great sign for the markets going forward necessarily.
I mean, not a great sign and not a great time as well. I mean, it's coming up as a prelude here for earnings season. And so, Chris, I wonder, if you're thinking about some of this weakness and how that carries through this post-economic data and how that carries through to this earnings season that's teeing off.
I think the March quarter earnings season is going to be really important, Brad. Not so much for the March quarter, but really for the guidance. And I say that because when you step back, the market consensus forecast for S&P 500 earnings this year is up about 10.6%, something like that. But it really, really picks up in the June quarter and strengthens in the back half of the year. So guidance is going to be key. How do these inflation factors fit in? Are companies still spending in areas we think they are? AI, data center, cloud, infrastructure spending in other areas. That's what we're going to want to see. But if they're feeling the pinch of these, higher inflation pressures, does that mean that those earnings expectations for the market have to come down?
Steve and Chris, I know our team was lighting up your phones trying to get you to come on, and this is the reason why. Great analysis and insight and perspective as always. Thanks so much for taking the time. Steve Sodnick and Chris Versace. Thanks. Coming up, is your retirement protected from inflation? We break down what you can do to protect your future. And inflation-proof investments you might want to make. That's after the break. Your retirement accounts may have taken a little bit of a hit today. After March inflation data came in hotter than expected, sending stocks plunging in early market trading. But before you scramble to reallocate all your investments, we're bringing in Yahoo Finance contributor Ross Mack. Ross, good to have you here in studio with us. Do people need to inflation-proof their retirement accounts?
I always look at this two ways, right? It's a short answer and a long answer. Short answer is, please, people, don't get scared. Don't deviate from your long-term investment plans, right? Because over the course of history, right, anytime there's a shock to the market, sure, but the market always recovers and goes on to make new highs, right? I had my aunt call me during the COVID crisis. Oh my God, what should I do with my retirement account? Auntie, you good? And later on that year, she'd thank me, right? But the long answer is, it's always good to assess what you're invested in. And the question can be, am I getting, from a risk-adjusted standpoint, am I getting exposure to some of those asset classes that, in this instance, are giving a good inflation hedge? And I think over the course of history, we've seen that one of the best inflation hedges is Bitcoin. Now, if you fell victim to saying, I don't want to own Bitcoin because XYZ CEO said it's a pet rock, it's a tulip, then that's a question you have. But now you see the writing on the wall, and it is an asset class that some top asset managers are actually going pretty heavy into. So now from a risk-adjusted standpoint, you can say from an asset allocation, it's okay to actually start getting long-term exposure into different asset classes that, in this instance, can provide some inflation hedging.
There are a lot of people that are looking for actionable advice today as well, especially with their retirement accounts, and even if they have a retirement account and perhaps a different account that they trade a little bit more actively in as well. And they're trying to figure out, okay, I've seen a run up, I've seen new highs for companies like Nvidia that all catch headlines, but what should I do right now? I mean, what would the advice or the reminder to them be?
Well, I think it's important to, one, understand what your overall long-term strategy is. And once again, we're not deviating. However, in this instance, you're going to be dollar cost averaging, right? Like, it's hard to say is Nvidia or Bitcoin or Apple going to be up higher or lower over the course of the next few months or weeks. But over the long course, you're saying, okay, I want to get exposure and I don't want to actually have to think about it. So dollar cost averaging is always going to be your best friend.
All right. Ross, stick with us. We've got much more to discuss here as major indices are under pressure after inflation comes in hotter than expected for the month of March. That means that everyday items are more expensive than they were last year, at least in aggregate. So all that money in your savings account that's been sitting around is worth a little bit less. To break down where you can invest to hedge inflation, Dave Nadig, who is the financial futurist, here with us in studio, part of our ETF report brought to you by Invesco QQQ. Dave, great to see you in person.
Great to be back.
Absolutely. So let's start off there. When we think about how people are trying to inflation-proof their investments, where is the number one, the first thought that should come to their mind?
Well, it's funny that you mentioned Bitcoin, because that's one that's come up a lot. It is up 71% so far this year. It's a little tough to say that that's a direct inflation hedge, but clearly that's part of the Bitcoin story. And for ETF investors, that's now a viable target, right? We've had 14 billion flow into the 9 new ETFs targeting Bitcoin since the middle of January. Obviously, a tremendous amount of investor interest there. But I think even the most aggressive financial advisors I talk to suggest sort of 1, 2, 3, 4% type allocation. So you're clearly not building your portfolio around that. What I'm hearing more and more is folks looking for inflation-targeted asset allocation solutions. The one I probably highlight is from Astoria, ticker's PPI. It's their inflation-sensitive ETF. And that kind of does what you would get if you asked a bunch of advisors all the question what to do about inflation. You get some defensive equities in there, energy, industrials, materials. You get a little bit of tips. Right now they're playing a little bit on the short end of the tips curve. You get a little bit of commodities. They're mostly focused in gold. And so far year to date, it's beating the S&P 500. It's beating gold itself. It's beating most bond portfolios. So it really has been working. So those kinds of what I would call point solutions for inflation have really come to the fore.
Yeah, certainly. I mean, when we think about the broad commodities as well, that consideration for many people who have looked at gold, looked at some of the other precious metals and tried to figure out, okay, even with the Fed's policy pathway, how that could impact some of those who are just holding gold at this point in time.
Yeah, and I think it's worth pointing out that we've got gold and oil sitting very high right now.
Right.
So it's a difficult time to make the case that now's the time you should be piling into these diversifiers as they ratchet up all-time highs. But looking at broad commodities, I like a broad approach that doesn't give you any funky tax treatment at the end of the year. Something like Invesco's PDBC, which doesn't give you a K1, gives you broad exposure. It's done reasonably well in the commodities space, but again, you should be expecting those to be counter-correlated. So if the S&P is going to continue its largely earnings-driven run, which I think we'll see because margins are still at all-time highs in the S&P 500, you're not going to expect those to both go up at the same time. So should we see a sustained pullback in equities, that's when you'd expect your gold, your commodities position, or even your Bitcoin to be working for you.
Yeah. Ross, you were just talking about Bitcoin and the exposure there, how some people could still benefit with that.
Yeah, I mean, at the end of the day, like you say, obviously later this year we have, well, pretty soon, the Bitcoin halving. But nonetheless, I think that there are other aspects to also look at when we think about it, other maybe defensive sectors, healthcare, et cetera. In that PPI, is there any exposure to any of those sectors?
No, it's really quite focused on those sort of defensive sectors that are more traditional in terms of things like energy, materials, industrials. And it's handpicked. This is an actively managed fund. It's got 35 stocks in it, and then uses ETFs to get things like the broad commodities exposure or the gold exposure. But I think it's an interesting point. We see a lot of people trying to position around equities. Remember that most equities trade on sentiment and flow far more than fundamentals these days. So if everybody thinks that those defensive equities are going to go up, you'll see them move long before the actual inflation is benefiting, historically what we would expect, the good cash flow, the pricing power, the inelasticity of demand.
It's interesting. I think a lot of us were thrown for a loop for a moment in our planning meeting earlier today because we were talking about, okay, some of the tips that Dave is going to bring forward. It's not just tips and key takeaways. No, it's tips. It's Treasury, inflation-protected securities.
Right.
Why?
So the break even on tips, basically you get paid that inflation uptick on your capital, is about 2.4, 2.5%. I haven't looked in the last hour. And that's pretty good right now, and we're seeing inflation print higher than that. That means that tips look a little bit like a buy. The challenge there is how are rate cuts going to impact that? So your duration positioning in tips, do you want to be really short? Do you want to be 10 years out? I think it's going to have far more short-term impact than anything else.
Dave Nadig, financial futurist, joining us here on set alongside Ross Mack. Ross is going to stick around. Dave, we're going to get by you. Thanks so much, though, for the time.
Cheers.
Appreciate it. Coming up, everyone, we speak with White House senior advisor Gene Sperling about the hotter than expected inflation print and what it means for the Biden administration. That's next. Reading more into the latest inflation numbers, one number that is really sticking out is auto insurance prices, rising 22.2% over the last 12 months. With about 90% of households owning a car, this data could provide a bit of an insight into Americans' anxieties about inflation prices. Now, Pras Subramanian joins us for more. Hey, Pras, what did you see? What stuck out in this report?
You know, Brad, I think you kind of hit the nail on the head there with that big headline number, 22.2% jump year over year, and the biggest component of all the inflation metrics there that rose. I mean, this is the biggest jump we've seen since December 1976, which was, by the way, last month was the biggest jump, and this month's even bigger. So when I speak of March, so that's a lot going on there from an insurance point of view. You know, a number of reasons why we dug into this recently. You know, there's a whole kind of a mixture of things. Like, for instance, the severity of auto accidents is rising. You have geographic locations because of the fact that certain weather patterns are more severe in the Southeast and things like that. It's state by state. It's a number of things, but also, Brad, note that, you know, insurance is a regulated industry, right? So you have to have insurance in basically every state. And that means that if you're basically forcing people to get insurance, the insurers can sort of, if they keep raising rates, it can keep the magnitude can be much higher than other things because of the fact that you have to have it. So there's a number of things going on there as to why these rates are soaring here.
And Pras, I mean, when we think about how long people can weather some of these heightened prices, especially on insurance, and where they're paying up in the travel experience, I mean, what are we hearing more broadly? Is it clear yet?
Sorry, is what clear exactly?
Is it clear how long people can ultimately handle some of the higher prices that we're seeing, especially in the insurance realm as well?
Yeah, I think people are nearing their limit here with the insurance hikes because of the fact that, 90% of people actually own cars. And if 90% of people in this country are paying 20% more for auto insurance, which is a pretty big component of their personal expenditures, that's a problem. You know, I was thinking to myself that there might be some more investigations from states' attorneys general, Secretary of States to look into why these rates are climbing so high relative to inflation, which, you know, is still rising, but not rising 20% year over year.
All right, Pras, thanks so much. Really do appreciate it, and diving into a very important element of the Consumer Price Index here with us today. Yahoo Finance's own Pras Subramanian. Thanks.
Thanks, Brad.
Well, revenge travel continues to go strong. 27% of Americans willing to take on debt just to travel this year. That's according to a Bankrate survey. I got a chance to speak to Delta Airlines CEO Ed Bastian about the demand that he's seeing for travel. Here's what he had to say.
I entered the year with a little bit of caution on the transatlantic, given how strong last year's transatlantic was. The revenge travel that we all saw, many people, you know, going to Europe almost at any price. I thought it might cool down just a touch. Hasn't cooled at all. We continue to see the strength of the transatlantic demand for the spring and summer continue, which is great. We're flying even a higher level of capacity this summer than last, and we expect our overall pricing levels are gonna remain, you know, largely the same.
Joining us now is Haley Berg, Hopper's lead economist. Haley, I just want to start off with your reaction to what you heard from the Delta Airlines CEO.
You know, what we're seeing here at Hopper is very much in line with our friends are seeing over at Delta. Demand remains strong, especially on some of these higher priced routes, transatlantic and transpacific. Customers are willing to pay a little bit more, but we are not seeing price increases year over year, which is fantastic. In fact, transatlantic routes to Europe are down in price about 10% year over year. Domestic airfare is down about 3% year over year. So on the whole, for those travelers, whether they do have to take out debt in order to travel or not, are seeing better prices than what they have.
Yeah, and it was particularly interesting within the airline fares index within the March Consumer Price Index. It actually declined 0.4%. So an interesting stat. One of the areas that we did see a decline in the report, at least one of the indexes there. How do you think that Americans, people who are traveling more broadly, are evaluating what that spend looks like now versus even a year ago?
What we have heard from consumers, no matter who we ask, any age range, is that they're continuing to prioritize expenditure on travel. Among younger generations, Gen Z, millennial, that percent of their wallet going towards travel is even increasing as they tighten their belts with higher interest rates. So if these younger generations who have pushed off milestones like buying homes, having children, they might be pushing those off even more given interest rates and focusing on travel expenditure. So we expect this demand to remain strong and continue as these generations age, build wealth. They're going to be continuing to spend on travel.
Haley, I'm not going to lie. I see a lot of people posting their trips on Instagram. I say, all right, do I need to add it to my Pinterest board? Do I need to just save it in my own Instagram? And whatever the case may be, you get some inspo, you get some tips, you know how to plan and book better perhaps. What impact have you seen from some of the data over at Hopper into how social media is impacting the broader experience economy and especially the travel component?
Social media has had a huge impact on how people plan and book travel. You know, a report we're putting out in just a couple of weeks is going to reveal some of the data we have around how Gen Z in particular looks at travel. And they actually use video social media like TikTok 7 times more than older generations when they are in the planning phase. And most of them research on social media before they book a trip, whether it be a hotel, a flight, even a rental car. So social media is the new battleground of where brands are going to be attracting consumers who want to book their travel. But on the flip side, social media is very curated, and younger generations, they're looking for authenticity. So a lot of these off the beaten path destinations that offer something a little more unique, something you might not have seen on Instagram, are becoming increasingly popular as well.
All right, I want to know the average height of the people that are traveling to Nice, France for $885. You can at me, I don't care. Haley Berg, Hopper's lead economist, thank you so much for taking the time.
Great to be with you.
Likewise. Coming up, we speak with White House senior advisor Gene Sperling about the hotter than expected inflation print and what it means for the Biden administration. That's after the break. Inflation remaining sticky, rising more than expected for the third month in a row. President Biden commenting on the latest CPI print, saying, quote, "Fighting inflation remains my top economic priority." He specifically pointed to his plan to lower housing costs and called out corporations for their possible role in keeping prices high. Joining me now on this, we've got Gene Sperling, White House senior advisor. Gene, thanks so much for hopping on short notice with us and taking some brief time here. I just want to know how, within the walls of the White House, this report, hotter than expected, is being discussed and what is being put in place to ultimately continue to combat inflation.
Well, first of all, larger picture, as we've often discussed, we're having an enormously resilient economic recovery. We're just a few days away from having had a 300,000 job number, or average of 276,000 jobs that nobody really projected months ago. We've seen unemployment stay below 4% for a historic period we haven't seen in over 50 years. But it has always been the case that our number one focus is on overall cost for working families. Of course, inflation has come down significantly from its highs, but it's not good enough for us. We would have liked to see this number come in lower. There's no question about that. But the way we look at it overall is, what is the strain on working families? What can we do? We'd obviously like to see prices come down more. Obviously the PCE that the Fed looks, was stronger than this. The last report had that at 2.5% over the previous 12 months, and core at 2.8. This came in. We would have liked to see this move in the direction, but we have to ask ourselves, what can we do overall for families? I mean, your show has been discussing exactly that there's mixes in prices here.
Well, certainly.
Airfare prices are down, used cars are down, dairy was down this month. I think some of the unhappiness, which is very understandable for people, is that in a place like dairy, milk, and eggs, prices are down, but they're still much higher than they're used to.
Sure.
So they're not, they're frustrated by that. I think one good news
Gene,
thing.
just to jump in, the other frustrating part of this too is one area where a lot of people are wondering what levers can be pulled either by the White House or by the Fed, and that's housing and the stickiness in shelter costs right now. Right.
Well, we all know that lags, and there's some debate about owner occupied rent, how important that is. But there's no question this is still, this is inflation in some of the service areas that we'd like to see moderate. But again, you asked the right question. What can you do about it? And that's why if you look at what the president talks about, not just talks about, but does, student debt, that's 30 million Americans who are going to have lower student debt. That's money they're saving. One thing we are happy to see is that even with inflation higher than we'd like, you are seeing real wages up over the last 12 months. So people should know, for the average person, their raises are enough to cover inflation and still have a little extra. But again, not good enough. So what are the areas? Housing prices. The president has called for 2 million more affordable housing prices,
right.
More supply reduces prices. For decades, prescription drug costs has been a main strain on families. Student debt for younger people and for people 30, 40 who still have that debt. The junk fees, the area where the president looks at overdraft fees or late fees for credit cards, all of these come out of your pocket in one way or the other.
Right.
So you're right. We have to look at where we have the policy levers. and make sure people understand that the president is fighting for lower costs and that there is a dramatic contrast in the legislative agenda, not just in prescription drugs, but in childcare, in affordable housing, where virtually everything we're doing is about lowering costs.
And Gene, just quickly here, because I have to hustle to my finish. We're going to lose the feed here in a hot second. You know, one of the huge things that we got to think about as well, energy. I mean, this is a massive year. More than half of the world is heading to voting in some form or another, and especially here in the U.S. as well. What should the American people be thinking about energy costs, especially as it relates to where the campaigns are going to stack up on foreign policy and where that could be an added exogenous threat in the energy equation?
Well, you know, one of the things the president has tried to do is give Americans more choices to have lower energy costs that are not dependent on everything that happens foreign policy-wise. We want people to have the choice between a car fueled by gas, a hybrid, or an electric car. But for those who choose to more electric, what they're essentially doing is saying their daily gas prices are not going to be dependent on Saudi Arabia or Russia or all of the different measures that all the different things that can happen in a volatile world market. So, you know, despite what some of the Republicans say, we're not forcing anyone to choose. That we want them to have a choice of an American-made car, an American Union-made car that gives us the option to take into our own the ability to have cars that to have your cost on a day-by-day level be less dependent on foreign policy things that can move oil and gas prices so significantly.
Gene, thanks so much for hopping on and taking some time here with us today to dive into the March Consumer Price Index report. Appreciate it.
Thank you. Thanks for having me.
All right, that was Gene Sperling, White House senior advisor here. So far this election season, poll after poll has shown the presidential race between President Biden and former President Trump incredibly tight here. The Real Clear polling for Real Clear Politics, averaging just showing President Trump leading by just 0.6%. So what does that mean for your portfolio? A new poll from the Certified Financial Planner Board shows that 83% of CFP professionals' clients expect the election cycle to have some impact on their financial decisions. For more on this, we have CFP Board CEO Kevin Keller here to help us explain a little bit more. Kevin, thanks so much for joining us in studio, fresh from Washington, D.C. I mean, you probably could have just sat next to Gene and had that conversation as well.
Absolutely. It's just 2 blocks from my office.
Exactly.
So it's great to be with you on a breaking news day.
Absolutely. All right. So one of the huge things that people are trying to think about in an election season, in an election year, how they should be thinking about the polling with relation to their own financial planning as well.
You know, here's the thing that the research showed. You know, last year was, by all means, 3 million new jobs. The economy was up, and yet consumer sentiment has been lagging behind, and today just isn't going to help that at all. But what was really interesting in the research that we did was that clients of CFP professionals are optimistic. 5 out of 6 of them are saying that they're really optimistic about the future and about the economy. And I think what that means is if you're working with a CFP professional, you're planning a long-term plan. You're putting in place a plan for the future. And that plan's going to look at whether ups and downs. It's going to plan for volatility like we're having. And I think that's one of the key takeaways is the clients of CFP professionals are more confident in their plan, and they understand that there'll be volatility along the way.
Yeah, it's interesting. You know, you mentioned consumer confidence. Their assessment, at least in the most recent reading here, of the present situation improved in March, but they also became more pessimistic about the future. Those comments from Dana Peterson, chief economist at the Conference Board and good friend of Yahoo Finance as well here. And it varies, of course, as you get into different groups and quartiles. But all these things considered, when you are planning for and in an environment trying to factor in the likelihood of a perceived recession, how do you look past the recession and through to those major goals that you've set up as well?
Yeah, I think that's part of what a certified financial planner will do when you're working with one is put in place a long-term plan and then revisit that plan along the way. as Ross said earlier on the show, he was talking about his auntie. Am I going to be okay, right? And he's like, yes, you know you are, but working with an advisor who's taking a look at your whole life, the holistic view of a person's financial life, I think prepares you for the volatility and allows you to make adjustments along the way.
And we're taking a look at some of the survey key takeaways here as well. And one of the things that I did spot within this was the remaining optimistic. A lot of your pro clients remain optimistic despite some of this ongoing economic uncertainty here. We talk about, and let's bring this full circle to what you mentioned at the top, today's economic data and how that can be a jolt of uncertainty. What then do you tell clients even amid those times?
Look, we know that this was a survey of CFP professionals. They have clients who are Democrats, they have clients who are Republicans. Yeah. And so the big takeaway is you stay focused on the future, make adjustments as you go along. Don't make short-term changes like Ross's auntie was talking about. Don't make short-term changes just because of news of the day. Keep focused on the long run.
Kevin, thank you so much for taking the time here with us in studio today. Appreciate it.
Absolutely. Great to be with you.
Absolutely. CFP Board CEO. Thanks so much. All right, coming up, inflation is top of mind for everyone today, and we've got a conversation on how you still think about saving, even when prices are likely to remain higher for longer. That's after the break. Okay, inflation still present, around for a while yet. At least that's what the latest inflation data is signaling. And that's hard on everyone's wallets. Shelter prices rising, coming in just under 5% year over year in a rise there. And then additionally, you're seeing food and energy prices both up 2% since last year. But there are a few ways to cut down on your spending that won't completely disrupt your lifestyle. So let's bring in Lynette Kalfani-Cox, who is the Money Coach founder and CEO. Lynette, great to see you. Thanks so much for taking the time here. I mean, after a report like this today, everyone wants the tips on where savings can turn into earnings here. So where is the number one spot that they can start?
Well, one of the things I always tell people to do is to focus on a strategy that I call switch and save. And so this is really all about doing something smarter with your money, the stuff that you're already spending on, and making wiser choices to get a cheaper alternative. Because frankly, it's, a lot of experts say, well, stop doing this or scrimp and save and sacrifice. And that just doesn't cut it for a lot of people, right? So there's many categories where you can use this switch and save methodology. So if you have, for example, a smartphone and you're about to spend $1,000 or so on that smartphone, maybe you think about going from a regular postpaid phone to a prepaid phone. Resource out there for you. Straight Talk Wireless has affordable, plans and those phones that are cheap for you to get. You'll save $1,000 almost for your family plan. If you have a credit card and you're paying 20% or so in interest, you should switch there to one of those 0% teaser rate cards. You'll save about $2,000 for the year. Again, another resource, card ratings can show you some good deals based on your credit. And then there's just, of course, the groceries that everybody is worried about as well. One easy switch there is to shop the perimeter when you're at the grocery store. So this strategy really just is about stop buying all the packaged, processed, kind of convenient foods, the stuff that's frankly not as healthy for us anyway. And then think about those fruits, vegetables, whole grains, the real stuff. Again, that'll save an average family about $1,500 over the course of a year. So those are just some ideas for thought starters.
Lynette, I'm going to be super personal here for a second. I have a problem with just Uber Eats, with Caviar, with DoorDash, with all of the delivery services here. Personally here, how can I make sure that I'm, rejiggering some of my own spending habits and ensuring that I'm applying a little bit more savings to my own spend profile?
First of all, you're not the only one.
Thank goodness.
I tell people this all the time too. There's a couple of budgeting tricks that I've found over my 2 decades plus as a money coach work really well with people. One is to factor some, what I call a fun fund into the budget. And that fun, F-U-N, and fund, F-U-N-D, means that you're going to allocate money towards the things that give you value, the things that resonate with you. So if you actually do want to go out and eat, no, I'm not one of those people who's going to say, never go to a restaurant, you can't have a latte, don't enjoy a great brunch. Just factor that into the budget. And then, of course, you have to obey what I call is rule number 1 of budgeting, which is you just can't spend more than you earn. And sometimes people go, well, duh, of course not. And it's like, well, yeah, duh, but you're not doing that because 70% of Americans are in debt, right? They're owing buy now, pay later, credit card debt, student loans, auto loans, all of this debt. We're up to our eyeballs in debt. So really sort of think about budgeting in a way that's realistic and sustainable, and then you won't fall victim to what I call frugal fatigue, where you just, been on lockdown so much and you haven't been spending, and then you feel that urge to splurge.
Lynette Khalfani-Cox, we got to have you back, the Money Coach founder and CEO. We're running up against the shot clock here on today's show, but we're shooting our shot at getting some people some wealth and some tips to save out there, and you helped us with the cause. Thanks so much, Lynette.
Absolutely. Happy to join you.
Absolutely. Everyone, that's it for us today. I'm Brad Smith. Thanks so much for watching. We've got much more wealth on Yahoo Finance tomorrow.